especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Tesla soars on its promise of making cheaper cars sooner. Meta takes the spotlight after the close today. More earnings. Boeing's cash burn will be in focus when its results drop before the open. And the Senate passes a $95 billion package of aid, clearing the way for fresh arms shipments to Ukraine within days. Plus, a Bloomberg Morning Consult poll shows President Biden is ahead in just one of the 7 swing states. Danny, good morning.
Good morning, Manus. It's the turnaround of the turnaround. Equities posting the biggest 2-day gain since February. We still have a ways to go to make up for some of the losses, but a couple of things helping us this morning. One, Tesla up nearly 10% pre-market. Earnings that literally disappointed in every single metric except for the promise of cheaper vehicles. U.S. 2-year yields, these were at 5% not that long ago. We've dropped below that, just above 4.9%. We're up another basis point this morning. Weaker PMIs at a 4-month low for the composite also added to bets that we will cut. We're back above 50% odds for a cut in July. That helping yields this morning, and an auction yesterday, a record 2-year auction that was well absorbed. Finally, Brent crude back below $89 a barrel, just about at $88 a barrel. Manus, this is a thing that can't hold a bid. As you were saying, Jamie Dimon saying he's surprised that we're not closer to $100 a barrel or more, but it is really the fundamentals that are driving the market, not necessarily a war premium.
Yeah, and there was a crack in the wall of the eco-narrative yesterday on the PMIs in the United States of America. Before that auction, Danny, came through. And in terms of the market narrative this morning, all eyes are on that Tesla stock. We'll keep a watching brief on it. It's up 10% pre-market. I mean, it's a typical Machiavelli kind of response from Elon Musk, which is either you're with me on autonomous driving, or you know what, don't bother being a shareholder in my company.
Yes, but if you look at the actual data, not the dream that he's selling, 5.5% operating margin, Manus, that's worse than GM. It is cash flow that is negative for the first time since 2020. In essence, he cut the prices to get more volume, but sales still languish, and instead, it results in weaker margins and cash flow turning negative.
And nor have they actually detailed what's going to happen in that much, much cheaper model for them. There's lots of promises about what they're going to produce, but we'll see a little bit more tangible on robotaxi on August the 8th. Well, our next guest writes this about the overall market and investor behavior. It still shows an overall constructive risk environment, institutional risk-taking modestly positive. And while it's far from a screaming risk on, it should benefit the same dominant companies as we get into the heart of the earnings season. It is Marvin Lowe, Senior Global Macro Strategist at State Street. I love that phrase. It's not a screaming risk on. I mean, if you take your mind back to the middle of last week, people were a little bit worried, Marvin. Yeah. Good morning. And that there was a shudder in the markets, and it was far from screaming risk on. Did you question yourself?
You know what? We question ourselves every day. You know, certainly valuations got pretty high pretty quickly. Consolidation is not necessarily bad. And without the catalyst of the bigger earnings names last week, you know, we were floundering on Fed talk, which was trying to pull back everything that they decided that they wanted to lay out at the end of last year. So we're past that. Now we're getting into earnings, and we'll get into more of those idiosyncratic stories, and we'll really see if the love affair that we've had with tech, me being one of those who love these companies and these business models, is warranted.
Can I just ask, I'm assuming the love affair doesn't extend to someone like Tesla, because this is the question with these big growth companies that have these huge valuations on it, is that the future cash flow needs to be there. Are you convinced that a lot of these big tech names, if you don't want to talk about Tesla individually, can actually show up with the promise of AI that they've been giving?
Yeah, I mean, one of the strengths I believe in, the Mag 7, if you will, and we'll take Tesla a little bit out of that story, is the fact that they've got these defendable moats, and they've had these defendable moats for an extended period of time, and they're just getting stronger. So yes, these cash flows, the ability to really financial engineer their balance sheets in a way that is a competitive advantage, is something that they retain.
It's interesting. I was chatting to Mandeep Singh, who comes on and covers our tech for BI, and he said, look at Apple and look at Tesla. They have been demolished because of their China exposure. Look at Microsoft, and Microsoft is virtually, it's moated from any exposure to China. This, the biggest issue in Mag 7 and in some of the narrative is your exposure to China and how quickly that can evaporate.
Yes, for sure.
And that's probably the bigger risk we need to recategorize.
Yes, for sure, for sure. And they are selling global products, and you have these very, very quick changes in what was some of the most important markets for these companies. And I think that the fact that it could change so quickly really catches folks off guard a bit.
What's the next growth engine then? If it's not China, do these companies turn their attention to India?
Yeah, for sure, for sure. The whole manufacturing process is also changing. That's going to be something that's a multi-year evolution. But certainly AI is part of that story, and I think that we're very, very early in that discussion.
Where are we in the bond market? Because we're trying to debate whether it's 2 cuts, 1 cuts, no cuts hike. So take your pick.
Yeah.
It's a wonderful buffet. At Bank of America with me yesterday, and they said, well, what if rates didn't change for the next 2 years? You may see a backup. And what is the worst case scenario in a higher for longer environment?
Yeah. You know what? I think it depends how you want to approach the bond market. One is just, ultimately how you trade, and we talk about that a lot. What part of the curve might benefit from rate hikes, from cuts going from 3 to 2 to 1 to hikes and whatever else, and there are ultimately ways to play that. I think that if we look at it from the perspective of what's priced out there, it's pretty fair. We've got a little bit of hikes. We've taken pretty much all the cuts out. Modally, we only have 1 this year. Have we moved that enough? We probably have, and we saw that just 1 data point. Remember, yesterday's PMI was not the primary ISM that we look at. It's granted, it's the version of PMI that drives a lot of the other global markets. But in the U.S., we usually rely on ISM to give us a look into service, to give us a look into manufacturing. So you could see how offsides the market was, and that's definitely a trade. If you're looking for that trade, probably the 5-year part of the curve is the cheapest, and there are ways to play that from a hedging perspective. But if we're talking about rates not changing for 2 years, one really has to...
I'm throwing that out there because that was Bank of America's thesis. So.
No, for sure. And it's something that we should think about because this lagged economic policy has been so long that one really has to ask, is the lag somewhat permanent? What does that say about the U.S. economy? What do rates need to look like in that type of environment? And then I think you wind up with a much less sanguine view where maybe 10-year yields need to be 5% on a regular basis rather than kind of the ceiling that we have now. And does the curve bear steepen, kind of in our parlance, in that type of environment? And those are the questions that we're asking because they're more intermediate in nature and they're probably more asset allocation important for the investors that aren't just the traders out there.
Marvin, we've run out of time to talk about Taylor Swift's new album. I know you're going to be disappointed we didn't get to it.
Next time.
Next time, Marvin. Thank you so much for joining.
Should get you merchandise for the next time you're in.
Yeah. We'll play some intro music for you if Taylor Swift will let us not have to pay for it. Marvin Lowe there. Thank you so much. I don't think we can afford that. Let's be honest. Okay, coming up, things aren't looking very Gucci for Kering. Well said. The luxury group is falling in trading this morning after a profit warning. That's coming up here on Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
It's Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. So Kering shares are tumbling this morning. The luxury group behind Gucci has warned that profit will plunge in the first half of the year. For more, let's go to Deborah Aiken, luxury analyst for Bloomberg Intelligence. Plunge is probably the correct verb here, Deborah. 45%, up to 45% of profits dropping in the first half of 2024. That is a painful slump.
Yes, it is indeed. The market was looking at 21%, and that was a big downgrade after in March they'd said sales would be down in the first quarter around 10%, and Gucci would be down around 20%. It came in down 18%. You know, if we look at what it's about, the brand is still not resonating. The brand is doing very poorly in Asia, particularly in a very soft China, which is softer than expected for everyone. So it has to be about very high-end brands doing well over there. There's not enough new product in there. And the carryover product, which from the prior creative designer, is just not hitting. So they really need new product in. Will be a 30% new product by Q3, and we push this to a earliest 2025 recovery.
Deborah, good morning. It's Manus. How much can Gucci rebalance itself away from China? Every tech company we're talking about has issues in China. The bottom line is politics and the middle class are the headwind to most of these brands in China. Can they rebalance from China, or is it something more structural?
I think it's more structural. We have, you know, China is by no means, when we go out of tier 3 cities, there is so much lack of visibility of top luxury brands still across China. And so there are many more brands outside of Gucci pushing for bigger content and exposure in China. And I think that comes on a long-term basis. But what you need right now in the marketplace is something that really resonates, your brand that is hot on social media, on video and others for the Chinese market. And Gucci just doesn't have that. 7% of its retail mix is from its new designer, De Santo, and that won't improve until 3Q this year. And even then, the product that was there is not backed enough. So they need to think about the redirection of the brand in terms of very high end and some product at the lower end, where they're in middle ground at the moment, and that is clearly suffering there.
Okay, Deborah, thank you very much. A pretty tough day for the stock at the moment on carrying. Well, Meta posts its results today after the bell, and generative AI is on the agenda. Analysts will be looking for signs of a stronger monetization of the company's video content. Alex Webb is with us. Alex, good to see you. So I think there's some magnificent number out there, 200 billion streams that we've seen on their video content. TikTok is taking flesh wounds. What are you going to be eyes on?
I mean, the main thing really to look at is the ad business, right? Meta is an advertising technology company. There is some expectation that the ad market is starting to pick up a bit. That will give Meta in particular some power when it comes to pricing. I think the thing when we think about AI is, yes, there is this whole piece with generative AI. Are they making money from licensing what they have been able to do in that space? But it also shows that they have been using artificial intelligence for some time in their advertising products. You know, it's well known that they have lots and lots of top AI brains working at Meta. Now people are recognizing that and say, well, what have they been doing? Clearly, they've been working on these ad products, and they've developed more and more sophisticated products in that space. Reels and products on Instagram are really starting to capitalize on those too.
Manus, here's something that's really evocative of what's been going on lately. Zuckerberg now more wealthy than Elon Musk.
There you go.
Yeah.
The rich list shifts. That's alliteration that could have gone badly wrong, couldn't it?
No, that was good, but it really does show the differing in fortunes of one which was the darling of the Mag 7, one that was falling out of favor. But Alex, if we are getting this TikTok bill passed, which we are getting it, Biden's likely to sign it, you get 270 days for them to divest. Does this ultimately just go back to help Zuckerberg, to make him higher up on that rich list and help Meta and help Reels?
If this thing goes through, right? I mean, it's going to go through, it looks like on a legislative basis, but there is going to be a big appeal from TikTok. A lot of people suggesting that on a free speech basis, the courts might actually block this. If the deal, if they do end up having to divest it or in fact just take the business out of the US, then there are probably three beneficiaries, of course, Meta and in particular Instagram, YouTube, which has, of course, now got a short video, vertical video format as well. And don't forget about Snap, the parent company of Snapchat. Not quite as big as those other two, of course, but could around the fringes be a beneficiary as well. But even though there are 270 days from President Biden signing this into law to the time when ByteDance would have to somehow divest this business, it could be longer than that by the time all the court cases play out.
Alex, we would never forget about Snapchat. Alex, thank you so much. Bloomberg's Alex Webb. Okay, let's turn to Boeing now. Boeing's free cash flow and capital reserves are going to be in focus, along with a lot of other things for investors when it reports earnings later this morning. Let's bring in Sid Phillips, who helps run our global aviation coverage. Sid, I mean, between the numbers themselves and just the chaos and as a new CEO coming in, what in the world are investors going to have their attention grabbed by?
Morning, Danny. So yeah, investors are going to be looking at cash. Cash is going to be king on the Boeing earnings, right? Because essentially the 737 MAX, which is their biggest cash cow, has basically been restricted from deliveries, and the company is producing fewer, and it's also sort of producing them slower. And so that's basically a major cash drain for Boeing. And together with an $8 billion loan with debt payment, it's going to basically have a massive impact on Boeing's cash balances. And so everyone's really going to be looking at what Boeing's talking about in terms of building up production again, as well as their new CEO, because they've announced management changes. And the CEO, Dave Calhoun, has said he's stepping down at the end of the year.
Sid, good to see you. So, yeah, he in theory will be there until the end of the year. I think that's very debatable in the market, isn't it? They're trying to buy Spirit, and that's all about control of the supply chain, improving the quality. Now, what is it that's causing that deal to go slowly?
Yeah, so Spirit is Boeing's biggest supplier. They make about 70% of the 737 MAX fuselage. But Spirit also gets 20% of their revenues from Airbus. And we understand that Airbus has been sort of negotiating with them hard on pricing, and that's really holding up the deal. Neither Boeing nor Airbus want to be basically having Boeing controlling supply, understand, with them, and we really have to see how that A350, which are Airbus's biggest models. And so Airbus is it's in talks, we understand, with them, and we really have to see how that goes. But for the moment, that's still going slowly.
It is indeed, along with the production, let's say, returning to some kind of normality. So thank you very much. We will see what those Boeing numbers are later. Now, earlier today, Bloomberg's Guy Johnson caught up with the Ryanair CEO, Michael O'Leary, to discuss the leadership at Boeing. And Ryanair, of course, previously had blamed Boeing's delivery delays for the slowing growth for their organization this year.
I've been reasonably hopeful. I mean, I think demand is strong on the volume side. We are pretty confident now we're going to grow to about 200 million passengers in the coming 12 months, up from 184 million last year. We will get about 40 aircraft from Boeing, less than the 57 we'd ordered, but that's enough to get 200 million passengers. And I would be reasonably optimistic that pricing through the summer will be up somewhere between 5 and 10% on last year. Capacity is constrained across Europe because of the Airbus fleet groundings, our Boeing delivery delays. So there's a lot of demand. People are going back to the beaches of Europe again. I think the winter has been so awful, people need a break, and they're booking Ryanair flights in their millions.
You bring up Boeing.
Yeah.
It has its numbers out a little bit later on today. What would you like to hear?
I would like to hear more of the same. I've spoken to Stephanie Pope twice in the last 2 weeks. I think she's focused now on getting the head down in Seattle, getting the aircraft delivered. We're seeing optimistic signs. I mean, we've seen aircraft now being pulled from the hulls, being moved from Wichita to Seattle, but without any defects being carried over. I think that's a good sign. It'll speed up the manufacturing process in Seattle, and I think we're now getting, with the new management team in place, I think we're going to hopefully see the end of these production challenges in Boeing.
Last time we heard from you on this matter, I think you were slightly more optimistic. You were expecting maybe 2, maybe 3 more aircraft. Do you think that number rises?
I think, I mean, we had been down as low as 35 aircraft for summer peak. I think we're back up now close to 40. You know, but I think we're seeing signs that they're getting on top of it. I mean, the big challenge for Boeing over there at the moment now is, is the regulatory burden. You know, they're in the crosshairs with Congress, with the FAA, everything else. I think that's why Calhoun has done a good job. It's why I'm sorry to see him go at the end of the year. If you're Boeing and you're making aircraft in Seattle, you need somebody who's actually managing the Washington relationships with Congress, with the FAA. I think Dave Calhoun, Brian West, the CFO, do a very good job on that. And you need people to do that job so that Stephanie Pope and the team in Seattle can manufacture the planes.
Ryanair CEO Michael O'Leary telling Guy Johnson that there needs to be continuity at Boeing. Okay, coming up, we're going to take a look at some of the market-moving events. You know what it is. It's Meta earnings today. We'll have that for you next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
We could face bigger challenges next.
It was going to keep Real World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg. It's your Bloomberg Brief. Danny Berger and Manish Kranny in New York. Let's get you set up for your trading day ahead. Boeing will be reporting its earnings before the bell after major safety concerns. Then we're going to get U.S. durable goods numbers. Those come out at 8:30 a.m. Eastern. After the bell, it will be Meta and IBM reporting their earnings. Manish.
Okay, let's have some quick check on your micro movers. Tesla is the dominant news theme, rising. They're touting an accelerated plan to introduce that lower price model. So they're not throwing the baby out with the bathwater. It's a lot of promises on that. Texas Instruments, Danny, issued a mildly bullish revenue forecast for the current quarter. And then you've got Visa up 2.78%, beating on the earnings. And the consumer, the hedonism of the consumer in the United States of America and beyond remains strong.
Yeah, I mean, talking about consumer spending being really strong, credit card spending. When it comes to Tesla, I think it's worth visiting this quote that Elon Musk said in their earnings. If someone does not believe Tesla will solve autonomy, then they should not be investing in the company.
I think it's very him, which is basically, I have a dream, autonomous driving, robo-taxis, AI, and if you don't like it and you don't want to pay me, because of course the pay and remuneration has been a very sticky issue, then you know what? Get off my stock register. But his margins are dropping, his sales are dropping, it's under pressure in China. So it depends whether you believe in the evangelism of the dream.
Well, if I can be really brutal, I mean,
you go right ahead.
I mean, Tesla had that recall last week for their Cybertrucks where the accelerator pedal was getting stuck and causing cars to accelerate. If you can't get an accelerator pedal right, why would I trust you with autonomous driving?
Well, you can level the same kind of accusations then at Boeing, and then you begin to ask yourself questions in terms of the 737 MAX and also the questions that are now being raised around the Dreamliner. What are affordable cars? The market needs to know is, what is the affordable car? How are you going to produce it? How much is it going to cost? I mean, these are the unanswered questions of the call.
Yes, because people were ready for the call because they said, we'll get some details from Musk. Instead, all he wanted to talk about, and you understand why, was robo-taxis, was AI, was robotics. And by the way, they ended the call with saying that their investor relations head was leaving. So what a way to end it.
There you go. How to win friends and win friends and influence people. There is another version of that statement as well. And also, how are they going to slash the cost of production by as much as 50%?
Yeah, is it a new car? Is it a new platform? We're not sure, so hopefully we will get those details. That's for another day, I suppose. For now, that's it for Bloomberg Brief. Surveillance is ahead.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
When you look at the relative earnings growth, it's going to decelerate for that Mag 7, and it's going to be overtaken by the forgotten 493.
It's not so much about the earnings results, it's about the reaction of the stock to the earnings results.
When we listen to earnings calls, we're starting to see a normalization in consumer spending trends.
What you are hearing is consumer demand that's held up better than a lot of people expected.
We get 30% of earnings this week. We got to go. Like, we got to get the engine humming here.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrell. One name to watch this morning, and that's Tesla. The stock is higher by more than 10%. And Elon Musk saying all the right things on a call yesterday. Much less about robo-taxis. Bramo, much more on less expensive models.
I view this as Operation Kick the Can to August, because essentially that's what we heard. We're not going to get any details about the way that they can produce $25,000 Teslas on their current infrastructure. Wait till August. What about robotaxis? Wait for August. And you know what? That was enough for shareholders.
We're going to wait for August. So let's look at this move this morning. I don't think you can look at this move without looking at it relative to the year-to-date loss. Before this, we were down by 4%, so now we're up by 10. Deutsche Bank's Jim Reed, I think, doing a fantastic job of framing just how far this name has fallen. AMH, listen to this. At its peak 2.5 years ago, Tesla was worth the same amount as the next 12 largest global auto companies. That's how much things have gone wrong in the last couple of years.
And recently, the big issue, of course, is demand. I love what Liam Denning says this morning of Bloomberg Opinion. He says Tesla has 2 very different first quarter results announcements, depending on whether you're more into the numbers or the words. The numbers, they were bad. If you look at some of the rate of which new cars are leaving deliveries, that is very not promising for Elon Musk down the road. But the words are dreamy, and it's this whole idea, to Lisa's point, August. We're going to get maybe a cheaper cars, or new cars, or cheaper Model S, and potentially a robo-taxi.
It goes through the reaction from the south side. Morgan Stanley, something for everyone. I think we can all agree with that. Jefferies, appeasing the market. That's the point I want to get on. How much of this was just about appeasing the market after all the concerns it's had over the last few weeks?
I mean, at a certain point, does it matter for Elon Musk what he actually promises if he could just get a longer leash to go and fulfill those promises? Ultimately, there's been a big question, and we've been talking about it a lot here. Is this a car company? Is this a tech company? To that valuation story you were talking about that Jim Reed pointed out, he gave enough hope, the dreamy talk that Anne-Marie was talking about, maybe to put this back into something more than just a car company.
It felt like Dan Ives of Wedbush wrote the script on the call for Elon Musk yesterday. I think this is exactly what he wanted to see. An adult in the room, I think that's something like what Dan would say. Let's talk about what's happening down in Washington, D.C. How many adults do we have in a room? $95 billion aid package passed, and apparently the clock has started ticking on TikTok. Is that true?
Absolutely. 270 days they have for it to face a ban or divest. This comes the day before the inauguration of the next president, but the president does have authority to then kick this can down the road for another 90 days, regardless of what happens with TikTok. Does it get divested? Is it banned? The issue will have to be dealt with the next administration. So it's either going to be Trump 2.0 or Biden 2.0.
Everybody can get on board with something that's not going to happen until after everyone kind of makes these decisions. I thought it was interesting, within that $95 billion aid package, there was also a provision about unlocking seized Russian assets and giving that funding to Ukraine, raising the question, do they have to pass additional funding for Ukraine, or can they use that money in a different kind of way in coordination with Europe? And it's something we're going to be hearing more about.
Yeah, this accelerates the conversation about the confiscated assets that are in Europe, particularly in France, in Belgium, as we go towards that leaders meeting. The G7 meeting just around the corner in the middle of June over in Italy. I want to talk about this poll that came out this morning. Bloomberg alongside Morning Consult. I think we put it this way this morning. The Biden bump, AMH looks over, and it looks over for now.
This is the latest iteration of our poll. The previous month, this came after the State of the Union. Biden did receive a bit of a bump. Now he's pretty much back to where he was before the State of the Union. And the issue continues to be the economy. If you look at voters and you ask them who's responsible for your concerns like inflation, they say Biden is responsible or very responsible. And then you ask them, how do you feel about inflation in the future? How do you feel about interest rates coming down? It's a grim picture. And this is what is really weighing on his poll numbers.
Mario Parker joining us from Washington, D.C. in about 25 minutes' time. Look out for that. Equity futures right now on the S&P, fading just a touch. We're positive by 0.1%. Coming off the back of the biggest one-day pop on the S&P 500, going back to mid-February. It's been a couple of months. In the bond market, yields higher again by 3 basis points, 463.14. German business confidence a little bit better than expected, but a euro still negative by 0.1%, 106.87 on euro dollar. Coming up this hour, Katrina Dudley of Franklin Templeton as stocks bounce back, Pierre Ferragut of New Street as Tesla speeds up plans for a cheaper model, and Brian Weeser of Madison & Wall with Meta earnings on deck. We begin with our top story. Tech heavyweights lifting the S&P 500 to its best back-to-back rally in 2 months. Katrina Dudley of Franklin Templeton saying this: strong economic growth is good for companies as we have a strong macro backdrop, but valuations are looking fair to us rather than expensive. Katrina joins us around the table. Katrina, good morning to you.
Good morning.
Let's get into the earnings. So we've had Tesla, we've had GM, we've got more coming up a little bit later. What's the message you're taking away from what we've heard from corporate America so far?
At the moment, we've had close to 20% of the S&P report. So we have a reasonable sample, but there's a lot coming over the next 10 days. Earnings matter. And that's really clear. The fact is if you take a look at what we've seen over the first quarter, basically the returns to the S&P are in line with earnings growth. So you've had valuations flattish. And that's where we come back to that comment. We think that valuations are fair. Therefore, for the S&P to work as we go through the rest of the year, we need to continue to deliver on earnings growth. So we've really got to start digging into the details and understanding what is driving earnings.
Let's start with sectors. Let's go within the S&P 500. Where do you believe there is greater scope for earnings growth this year?
I think the easy one is the technology sector, and we can sit here and talk about AI, but I don't think that that's news to anyone there. We're looking at financials as another area where you've seen some good earnings momentum, and we expect that to continue. Some of the areas where we're starting to see weakness, though, are the healthcare sector, which has typically been such a defensive area. I think the expectations there are for earnings to have some degree of pressure. And then finally, energy and materials. But when I look at earnings in energy and materials, I think about it in terms of so much of their revenue is outside of their control. They've got the costs under their ability to influence. Therefore, I think that using that as a barometer of earnings is a really good guide to the future of the market.
Just to dig a little further, you were saying that you expect earnings growth to come in big tech. More than the valuations already priced in so far?
I think that the valuations that are priced in so far are actually pricing in the fact that this is the place that you want to be in terms of technology. When we look at tech, however, we take a much broader definition of where tech impacts. And so we're not just looking at those magnificent 7, where the valuations probably are on the fairish to upper end of where we think is reasonable. But we're looking at where the second derivative impacts of AI are going to come into effect. I look at our business and I look at how we're deploying it. And we're deploying deploying it not just in terms of our commentary writing and helping that. I'm actually deploying it as I work with my team and looking at agendas for how I have their review conversations. I look at for agenda planning for meetings. So me as a person, it's starting to use AI in a very blunt manner to make myself more efficient and more effective.
There's a question of hope versus dollars and cents. And we were talking about that in terms of Elon Musk and Tesla. And it really comes down to, as an investor, do you invest in the hope of capital expenditures, of promises, of shooting a high, or do you really focus on the dollars and cents? How much money are they bringing in, and what does their cash pile look like?
I think the first thing is you invest in credibility. And that is what we have to do. That's why we go in and we meet the CEO and we look at them in the eye and we say to them, what do you think you're going to deliver? And what can I metric you on? Because that's something a CEO has the right to tell us, is that these are the things that I'm focused on and I'm going to deliver. The good news is if you have longevity as a CEO, and longevity here is a probably relative term, I can kind of use your own history as a guide. Did you deliver last time on the promises you made? And that's usually a good indicator that you'll do them. So I would say it's not necessarily hope. It's about having that conversation with the people that matter, then understanding what those metrics are. And then we go out and we try and form that mosaic of how do we assess those metrics and whether they can deliver.
Have earnings fully trumped the bond market at this point, at a time when we are seeing sort of whipsaw moves in yields appear to still influence stocks, even if people want to say that they don't?
Look, as we go into an environment where we have inflation easing, we will see a decoupling of the bond market and the equity market. That's something that we've had in the past, of those markets both working in tandem. We are expecting rate cuts coming into the second part of the year, but we are also hawkishly watching that inflation number. As I look at what the expectations, though, and that's really what that drives that bond market, it was 6 cuts at the beginning of the year. That's only 4 months ago. It wasn't that long ago we were expecting 6 cuts. Now it's down to 4, potentially 2 to 3 is what our CIOs are telling us.
When you look at earnings, you talk about energy and materials, and you expect them to drop 8% and 25% respectively. Mm-hmm. But if we continue to see this commodities rally, would now then be a good time to buy into these sectors?
I think the 8% drop is in terms of healthcare earnings. And so that was what we were talking before. And there's some definite pressures there that we're seeing in the healthcare system. As we look at the energy and materials sector, I think really that sector is a good barometer for what we're expecting in the macro environment, number one. Number two, it is also a kind of second derivative play on emerging markets and what you're expecting to see in those environments. As we look at some of these emerging markets, I think that there's a bit of a bifurcation here, because there's some of these emerging markets that have got some really good, strong trends, but there's also a lot of geopolitical tensions. And when we see a rise in geopolitical tensions, the emerging markets just cannot escape that.
Can we finish on Japan just briefly? So we came into April worried about 152. We sliced through 152 like a hot knife through butter. 153, 154. We're looking at 155 this morning. We came close, 154.97. What is it going to take for Japanese officials to step in, and can they change this trend?
I think what the Japanese officials are looking at the moment is things that are actually really within their control and make a lot of difference to the equity markets. And this is a change. We have not had a regulator in Japan that is actually looking at capital allocation and how companies are allocating capital. So I understand the narrative, and I do know that everyone is focused on the BOJ and what's happening there, but we're actually focusing on the ground, and we're looking at the message that's been given to companies. And I think that that's just got such a much longer tail to it, and I don't need to really make a call on what is a binary decision here.
You're not alone, let me tell you that. If you ask people their 2 favorite sectors right now, they might talk about what's happening with tech. You ask them about their favorite regions, they will name 2. The United States and Japan comes up repeatedly. Katrina, this was great. It's good to see you.
Good to see
Katrina
you.
Dudley there, Franklin Templeton, very close to 155 on Dalian. Right now, 154.92. At the moment, Bramo, the high of the session, 154.97.
This is what's interesting to me. When we talk to people, everyone's going to Japan. Every single person who comes in who's doing an international travel has been to Japan, and they say there's actually hope, there are dreams, etc. At what point, though, if you get a depreciating yen, does it become a headwind for some of these investors? And it's something that we hear more as the days go on.
Let's get you up to speed on news news elsewhere. Let's get to the Bloomberg brief. We can kick things off with shares of Tesla. Surging in the pre-market, the EV maker accelerating the launch of less expensive cars in a bid to revive sagging demand. The news overshadowed a big shortfall in company first quarter earnings, sales and margins. The CEO, Elon Musk, says he wants to start production of the cheaper models this year. Your second story from JP Morgan Chase CEO Jamie Dimon says he's on the cautious side of a soft landing, but he's optimistic on the state of the consumer.
Even when we go to recession, the consumer's in good shape. But that doesn't mean you can fight off the effects of stagflation or something like that if it gets much worse. And so, you know, I worry that it looks more like the 70s than we've seen before. If you go back to the 70s, deficits were half what they are today. The debt to GDP was 35%, not 100%. And so part of the reason I think we've had this strong growth is the fiscal spending.
Dimon spoke at the Economic Club of New York just yesterday. And finally, quite a story, the FTC voting to adopt a near total ban on non-compete provisions that prohibit workers from switching jobs within an industry. The Chamber of Commerce vowed to immediately challenge it in court. The legal showdown comes 3 years after President Biden signed an executive order encouraging the FTC to limit non-compete agreements, which affect roughly 1 in 5 Americans. The rule does not apply to existing non-competes for executives who earn more than $151,000 a year in a, quote, policy-making position. So any execs out there this morning who were getting excited about breaking their non-compete, maybe don't get too excited. I remember the late, great Alan Kruger gave me an education on this many years ago, and he talked about how important this was for fast food workers. I was sitting there, I was like, Alan, what are you talking about? And he broke it down for me. I could not believe that if you work at a fast food chain, you have to sign some of these. And in some cases, you can't even go and work for the same chain at a different franchise. They prevent you from doing that as well. So this is not about the bankers of this world. It's not about the execs. It's about what happens in the lower paid jobs in America.
Which is a reason why this is coming now. I find this really interesting. I personally saw this, especially in tandem with a rule that would go into effect that would allow certain types of expansion in overtime payments. It raises a question, what are the knock-on effects, though, at a time where the FTC has taken a much more aggressive approach to monitoring business? The intent has a lot of resonance in the American society. There is a question about the precedent being set that I think a lot of people are going to be compelled to discuss.
Lena Khan also spoke about when they opened this up for comments. A lot of those comments came from individuals in the healthcare space. But you have to think, state by state, some states already outbanned non-competes, so you can't even have it. Knock-on effect, I think, is going to be a ton of legal action. We've already seen it from the Chamber of Commerce, and also a political win for Biden. 2.5 years ago, an executive order telling the FTC, do something about non-competes. 6 months before the election, here we go.
Easy now. Political win at the moment. This is going to get caught up in appeal after appeal. Up next on the program, Tesla doubling down on cheaper cars.
We know that when Elon says something, it often takes 4 years after the initial comment. So I can't rely on what he says as a time frame, because those are usually his goals, not necessarily a reality.
Some people have their doubts. We'll talk about those doubts up next on the program. Live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases, or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Earnings season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been? Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Equity futures on the S&P 500 positive here by 0.1%, just a little bit of a lift here. Yields higher as well by 3 basis points. A 10-year 463.35. Under surveillance this morning, Tesla doubling down on cheaper cars.
I don't see how they're going to pull forward production of this vehicle to be ready in a year after they just laid off 15,000 people and a lot of factories and a lot of high quality individuals just lost their jobs. So I'm kind of curious to, we can say things, but we know that when Elon says something, it often takes 4 years after the initial comment. So I can't rely on what he says as a time frame because those are usually his goals, not necessarily a reality.
Here's the latest this morning. Shares of Tesla jumping on its plans to speed up the launch of cheaper models. The EV maker also posting better than expected results despite a miss on earnings, sales and margins. Pierre Farragut of New Street Research writing this. The world didn't play out as expected. Demand for expensive EVs didn't grow as much as hoped. In 6 months, Tesla adjusted strategy in order to make the most of assets on the ground before investing in the next round of production capacity. Pierre has a buy rating on the stock, a 280 price target. Pierre joins us right now for more. Pierre, you have an original take on this. You think something much bigger is going on here, not just a CEO trying to please investors on an earnings call. Can you walk us through how big a change you're expecting from this company?
Yeah, I think, John, thanks for your comment. And to be honest, my perspective is not that, original. What's original is how the news came to us and how, things got spun into a misunderstanding. So you remember that article from Reuters a couple of weeks ago mentioning that Tesla was dropping the Model 2. Of course, there is no smoke without a fire. There was something happening that Reuters journalists saw happening at Tesla. And we tried to put our head around what Tesla could be doing. And people thought maybe the Model 2 is going to be canceled or postponed, but it didn't really make sense. The reality was actually the exact opposite from the way Reuters presented the situation, which was the Model 2 initiatives suddenly come across as being something that needed to be accelerated and not postponed or canceled. And that's what Elon Musk told employees in February. He said, guys, we were planning to sell 3 million Model 3 and Model Ys a year. At these price points, it's not going to happen. The demand is not large enough at these price points for that to happen. So we need something like a Model 2 that comes in earlier, number one, to continue to grow. And number two, we've planned for capacity for Model 3 and Model Y that is way too much because we're never going to sell 3 million units at a price point that makes sense based on the cost base today. So let's take some of the projects, like the plans we have, part of the Model 2 next generation platform, and let's actually integrate these innovations into the Model 3, Model Y platform in order to be able to hit the market ASAP with less expensive cars. And so what I see coming through in 2025, and I think Ross has a point, let's see how fast it comes. Elon Musk tends to guide for things to happen very, very fast, and they take a bit longer to realize. But it's going to happen soon because it's not going to be about building a new production chain and tooling a new manufacturing line. It's going to be adapting the existing manufacturing lines in order to take some of the cost reduction initiatives of Model 2 and integrate them on the Model 3, Model Y platform. Yeah. That's what I'm expecting to see coming. And the Model 2 will come later once existing production capacity will have been fully utilized.
Pierre, I am wondering whether it bothers you at all that we got no details, that the line was basically wait for August and we'll tell you more about how exactly we're going to do this.
No, I think it makes a lot of sense, you know, to do you get details about the next iPhone before Tim is presenting it at an Apple event? You know, you have to remember that Tesla is not running an IR department. They're running like a car company. So they have to be very careful to talk about what they're doing and reassure investors the way they can with public information. But they don't want to disrupt their business with too much information being given to shareholders. You know, let me give you like a simple example. If they were saying, we're aiming in a year from now to have like a Model 3 that is going to be 25% cheaper than what it is today, that might have like a disastrous near-term impact on sales for Tesla. So to me, it makes sense to be very vague and, you know, high level on guidance. And then on the robotaxi per se, I think Elon is giving actually a lot of details, but that's details about his dream, about like something that is still like very much of a moonshot and like a vision. You know how this AI models are evolving. Sam Altman describes that very well. You develop a new model and you're facing a veil of ignorance. You don't know what the model is going to do next. You just see that the technology is improving and is building up capabilities very rapidly, but you don't know what's going to happen next. So Tesla is working on these new models. They have additional compute processing power. They are developing in-house models that are like, according to Elon, like very impressive. Putting that into a robotaxi, putting a robotaxi on the road, to me, is still a process that is going to take another, 3 to 10 years, and 3 years. To be honest, I don't really. I would be skeptical. So, in August, they're going to talk about the platform, how the robotaxi car, what the robotaxi car is going to look like, what the embedded technology is going to look like, how like the technologies, the software is going to differ from the mainstream car. And then once they have these platforms, these prototypes, they have to produce it, they need to deploy test fleets and things like that. And it's still going to be a multi-year project, and still to be qualified as a moonshot.
The stock agrees with you this morning. Pierre, it's great to get your view on things right now. Pierre Farragut there of New Street Research. That name is up in double digits this morning, 10 to 11% higher. This from Pierre Farragut of New Street. After those earnings, this could be a case study for the Harvard Business Review.
Basically, how you deal with trying to expedite a cheaper model without having to build a whole new infrastructure. Whether he actually can do it, I mean, it's sort of interesting, the sort of benefit of the doubt. Well, of course, you're not going to release any details. It's a car company, even though it wants to also be a tech company, and you're really going on faith.
But when it comes to robotaxi, I love what Musk said on the call. If someone does not believe Tesla will solve autonomy, they should not be investing in the company. He is throwing really all his eggs in this basket. That may be on the side to assuage some investors' concern. Don't worry, we're going to have a cheaper price point when it comes to the EV.
Pierre mentioned investor relations. Do they have that department at Tesla?
I believe that person resigned after the call yesterday.
So, there you go. Equity futures right now positive by 0.1%. And coming up next, we'll catch up with Bloomberg's Mario Parker on the latest Bloomberg Morning Consult poll, focusing on key swing states, the Biden bump evaporating. That conversation up next.
that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Coming off the back of 2 days of gains on the S&P 500, equity futures slightly elevated by 0.1%. On the Nasdaq 100, encouraged by some of the moves elsewhere, the Nasdaq is up by 0.6%. We'll talk about Tesla in just a moment. Off the back of the biggest one-day move on the S&P 500 in about 2 months. In the bond market, bit of a bid yesterday. Decent auction at the front end of the curve. Softer economic data supporting that decent auction, some might say. 463 on a 10-year, 2-year 493.73. Who would have thought? PMIs in America. S&P PMIs would get everyone encouraged that the economy was slowing down.
That was exactly my point. Is that how low the bar is for any potential miss or sign of weakness, that'll give a huge boost to bonds and stock markets pretty much across the board? You got weak PMI data, but more importantly, and this is what people looked at, the internals of the S&P Global PMI data showing the weakest hiring levels, particularly in services going back to the height of the pandemic in 2020. This was enough to be the first punch. And then the second punch was the auction. It came out, record amounts. Oh my God, are people going to come out? They did, and it was fine, and you saw that continue.
Yeah, that was $69 billion of 2-year notes, and I think later today, Lisa's got the numbers. She knows them. 70 billion of 5-year notes. There we go. All right, that's the bond market. Let's turn to foreign exchange. I'll talk about the euro briefly, and we'll throw in some dollar yen as well. The euro at the moment is negative about 0.1%, staging just a little bit of a recovery. Business confidence in Germany doing okay, not stellar, but doing okay, 106.91. The fireworks could come from dollar yen at any point, getting closer and closer to 155, 154.92. Just remember where we were coming into April, looking at 152, gone, 153, gone, 154 through that level, staring down the barrel of 155. And I would say this, officials in the finance ministry have got quieter and not louder over the last few weeks.
Partly because people have rejected their verbal intervention. It's lost credibility. And at a certain point, is this going to come down to what they decide to do and when they decide to intervene, or is this going to come down ultimately to what data comes out? And maybe we'll get another S&P Global softer PMI print, and that'll be enough to bolster some of the yen valuation.
That's what they need. A few more of those. Perhaps. That's the price action in foreign exchange. Let's get to under surveillance this morning. Our top stories. Tesla ramping up plans to launch cheaper models. The EV maker hoping to start production as soon as this year. The announcement overshadowing a shortfall in Tesla's first quarter earnings, sales and margins. Their stock is up by almost 12%. Elsewhere, Kering shares falling on slumping sales of its biggest brand, Gucci. The stock near its lowest level since 2018. The luxury maker also warning profit will plunge in the first half of the year as demand eases in China. Kering is lagging behind some of the other big players, including LVMH. We're down here by 8% on the morning.
So there are two questions. How much is this story, and I'm sure you guys can do this much better than I, about designers or sort of their customer base? It's very idiosyncratic. And how much is this truly a bifurcation between the ultra-rich, which are doing great, and the lower class, which are not doing well? And if you try to hit the middle, not so good. And that's kind of what they kept on kind of pointing to, is that we're the accessible fashion, and accessible fashion isn't in vogue. You might have a different take.
So if you ask the CEO of Kering, they'll go with the former, or rather the latter. They will say this is about the polarization of the luxury goods market, that ultimately it's either hyper luxury or it's low end and it's super accessible. They're somewhere in between. They can't get it done. Of course they would say that. If you ask other people about this, they'll point to the designs and how much the designs have changed over the last few years. And ultimately, they built out this consumer base with a very particular design, then they've changed it, and that consumer base is not there anymore.
That's what I think, because you had Alessandro Michele at the helm as the creative director. This extrovert, he did some wild things. He brought like the New York Yankees logo to their loafers, and then they realized, well, this is actually a younger audience. How do we broaden this base again? So then they brought in Sabato Di Sarno, and he's a little bit more classic. You see
From Valentino.
From Valentino, which is very quiet luxury. And then what you see them putting out are things like the Jackie O handbag. This was the style in the 50s and the 60s with the bamboo handle. But they just did all this work to bring in a younger generation. So it's going to take some years for them to recalibrate to this new creative director and his design vision.
We need to get the CEO on the show so we can have this argument.
Yeah. Do you like loud fashion?
No.
What do you think of? I mean, isn't that essentially what this is? I wasn't asking you. I was asking the CEO.
I'm not big on logos and brands.
Well, but that wasn't that Gucci's whole thing.
Not a big
I
fan
mean,
of platforms.
But that's the whole thing. If they want that crowd, you know, if they want that crowd, they got that crowd, and now they're ditching that crowd, and they're wondering what happened.
Francois Pinault in Vogue recently, I didn't want a rupture, I wanted an evolution. They wanted to bring more people back in.
Like John.
But it's very different to go from Alessandro Michele to Di Sarno. It's apples, oranges.
The Kering is down by close to 8%. Who would have thought that would be the most excitement we'd get around this table this morning? Elsewhere, President Biden pledging to sign a $95 billion aid package for Israel, Ukraine and Taiwan. The deal passing in the Senate last night. The Defense Department hoping to resume arms shipments to Kyiv in the coming days. Biden's signature will also start a countdown for ByteDance to divest from TikTok or face a ban. We can spend lots of time talking about TikTok through this morning. I just want to say this on the foreign aid package. Only a month or so ago, this was almost unthinkable that this would pass. The doubts around this were absolutely massive. A little bit later, we'll catch up with Henrietta Trays of Vader Partners, and I think it's important to question the amount of influence, or lack thereof, the former president still has over the Republican Party, particularly on this issue.
Well, I would go down to the vote cap. You're sure the Senate passed this as one bill, but the vote count in the House was 4 separate bills. And you look at where it was on Israel, you look at where it was Taiwan, a lot of bipartisan support. There was still bipartisan support for Ukraine, but you saw a lot of protest votes when it comes to Republicans, which makes me think, is this the final aid package then this kind of Congress can get through? And what does this spell if we do get a Trump 2.0?
Some people might argue that Trump did give his blessing in the form of not asking for Mike Johnson's ouster, that maybe that was enough to give them the belief that Republicans wouldn't get pilloried if they signed off on this. He wasn't aggressively arguing against it. So maybe people were saying he's kind of not really against it anymore. But you heard this kind of, you know, pretzel twisting down in Washington, D.C.
He was against the TikTok effort. And apparently he's ready to blame President Biden for getting rid of your TikTok if that happens.
Yeah, well, he wants it to happen before he can talk about people getting rid of it.
It depends what year you're talking about, if Trump was against or for the TikTok ban, because he also tried to ban it when he was in the presidency and had the White House. But now he's like, if it gets banned, he wants to blame it all on Biden.
Yeah, I remember the combined effort. Was it Oracle and Walmart back in the day? It's so weird.
Well,
feels like ages ago.
There was a great article, I think it was in the Wall Street Journal, about Jeffrey Yass, who is the billionaire who has been the biggest Republican donor, and frankly, the biggest donor during this political cycle, who has almost all of his money tied up in TikTok. It kind of gives some color to this whole issue.
If you want a decent feeling for how quickly time flies, yesterday was the 4-year anniversary of the Inject Bleach speech, that address.
That
Did you
tweet
see
was
that?
gold, yeah.
4-year anniversary?
Yeah.
4 years, where's that gone?
It's crazy.
I remember sitting there in the living room watching that address in the press conference. It was some weird times, let's put it that way. Equity futures on the S&P right now, up 0.1%. Equities are doing okay, coming off the back of 2 days of gains. We need to talk about some of the recent polling. President Biden losing ground in key battleground states. According to the latest Bloomberg Morning Consult poll, Biden now leading in just 1 of 7 states in his matchup with former President Donald Trump. The results showing a fade from the post-State of the Union bump for the president. Bloomberg's Mario Parker joins us now for more. Mario, let's talk about that bump, where it was coming from, and ultimately, why it's fading.
Sure. I mean, the main thing, Jonathan, is the fact that Americans remain pessimistic about the economy, namely inflation. One of the problems, you all just talked about some of the nostalgia from 4 years ago. One of the frustrations for President Biden and Democrats is the fact that Americans remember the prices, the lower prices that were around during the pandemic, but not some of the other stuff that happened with the Trump administration during that time as well. And so right now it's been an albatross on his reelection prospects.
Mario, though, when you look at some of the other polling data we have, Biden does poll well with suburban women, and the issue of abortion continues to come up. Is this where we can see the president really lean into this November?
Well, that's the bet that the president is making, right? You saw him earlier this week go down to Tampa, Florida, right? Which is essentially a move that suggests he's going on offense, even as polling shows him trailing in some of the key battleground states that he needs to defend. But he went down there carrying a message about abortion. He's hoping, and the Democrats are hoping, so far, anytime abortion has been on a referendum, it's been abortion rights have gone in favor of Democrats, right? So they're hoping that, hey, let's swing for the fences and put all our chips in the middle of the table. Come November, we'll be able to galvanize turnout among independent suburban women and also the Democratic base. The problem is it's just not showing quite yet with the potency of the economy.
And then, Mario, the third rail of politics is entitlements. Any politician that comes out and talks about potentially reforming Social Security or Medicare, you pretty much no longer may have a job. But on our poll shows that there is one provision potentially that could work to shore up Social Security that voters actually like.
Yes, and it's that's the taxing the rich, essentially, billionaires tax. And to your point, Anne-Marie, it is the third rail. You saw in the Republican primary just how potent an issue it was, because you had former President Donald Trump kind of waffling around the issue, he and Nikki Haley, on that. Just because given, if you recall, older voters are a reliable bloc come November. No one wants to alienate that block at all. But yes, the overwhelming, about 77%, I think, of the respondents to the poll were in favor of taxing billionaires in order to make sure that the program remains solvent.
Mario, I love this part of the political cycle where we get to find out why Michigan, Georgia, Arizona, Nevada, North Carolina, Pennsylvania, and Wisconsin have that much greater clout over all political decision-making than any other states in this country. We saw Michigan, President Biden gaining by 2 percentage points, but losing in all of the others. What types of proposals, provisions, lip service can we expect from President Biden to try to get the Georgia, Arizona, Nevada, North Carolina, Pennsylvania, and Wisconsins on board?
Ooh, that's quite the list, right? You got about 7 months or so, if you're the president, to essentially blitz those states as much as possible, to get there as much as possible, to generate earned media with those trips. And one such trip is he's going to give the commencement address at Morehouse College, a historically black college and university, a male university in Georgia. What we know right now is that the black vote, the young male vote, Georgia, all those things have been blinking red lights for the president. So you'll see the campaign find creative ways to visit some of those states to deliver messages tailor-made to some of those states as well in the coming months.
Mario, do you think Biden can win without winning the blue wall?
No. And I don't think the Biden campaign, just speaking with them, they feel as though they have to absolutely keep that blue wall, the blue wall being Michigan, Wisconsin, Pennsylvania. That's absolutely vital. You have to at least win 2 of the 3 for sure. Ideally, you have to win all 3 in terms of getting back to the White House if you're President Biden.
Hey, Mario, appreciate your time this morning. Thank you, sir. Mario Parker there of Bloomberg on the latest Bloomberg Morning Consult poll. Lots of interesting details in here. This is the one that stood out for me. More than 3/4 of poll respondents said the president is responsible for the current performance of the U.S. economy. Nearly half said he was very responsible. If things improve, do they thank him? Because at the moment, the perception of the economy, very, very different to what we talk about around this table. We talk about solid economic growth, jobs are plentiful, the disinflation at the start of the year, challenge to that for sure. But ultimately, the views around this table are very different to how things stack up in a polling across this country.
Which is the reason I would take your question and say, even though on paper things look good, why are they not feeling it, and why are they blaming him for the negativity that they feel? You can tell that this is a source of frustration for the White House, and we can debate exactly why this is taking place, but it speaks to the two-speed economy that Mike Wilson was talking about, that we hear about with the front of the bus and the back of the bus when it comes to airplanes. There is a very kind of motley picture of the U.S. economy right now.
It's very hard to land this argument on voters' minds. Inflation, the rate of inflation is coming down when they remember the price of goods before Biden was inaugurated. And I think this story is going to get even more worrisome for the Biden administration. Gasoline this morning averaged $3.66. We're close to $4, and it's not even peak summer driving season. This is going to be a challenge.
This is far too serious. If TK was still here, he would love the following story. Let's leave behind America for a moment and go to the UK. In London right now, at least 2 horses are on the loose in central London. The horses reportedly from the Household Cavalry, which works at Buckingham Palace. They're tracking these horses down.
I've seen those horses.
You've seen that?
I was about to
Beautiful
say,
horses.
is there a horse cam? Sort of like the airplane
We should try
cam?
and find. I'm sure someone's
Yeah,
done that.
And we could put it just sort of like on the little
big
down
Jet
here.
TV on
Yeah,
YouTube.
totally.
Watch the
Exactly.
planes land.
We did that all day.
The
one morning.
trainers
Chasing the
take
horses.
them out in Hyde Park, and you can go running like right next to the horses. It's fantastic. But a little
I'd love-
scary, I think, if they're on the loose.
I'd love the backstory to all of this. That's the latest from the United Kingdom. Super serious stuff. Let's get you updated on stories elsewhere this morning. Here is your Bloomberg brief. Let's kick things off with Visa. Shares rising in the pre-market after the credit card company's earnings topped Wall Street estimates. Adjusted net income for the fiscal second quarter rose 17% to $5 billion. In the US, where Visa gets more than 40% of its revenue, credit card spending grew over 6% from a year earlier. The earnings follow last month's news that Visa and MasterCard are now allowing US merchants to charge consumers extra for using credit cards, a move retailers say will save them at least $30 billion over 5 years. And Netflix is doubling down on its global ambitions. Bloomberg's Emily Chang speaking to the company's chief content officer about the strategy.
Latin America has had a rich history of storytelling. So many great movies and TV shows, and there's great creative ecosystem there. And what's been great is just to see it continue to grow and to continue to expand the variety and quality of what we do. And that means local creative executives and local production executives, and really having people on the ground who speak the language, who come from the culture, and to really work locally in that community. And that's, taking time to build and grow and have that, maturity in that market that way for us.
You can watch more of that conversation, Emily's interview, on the circuit on Bloomberg TV, streaming at 6 p.m. Eastern Time, and Bloomberg Originals streaming at 8 p.m. Eastern Time as well. We all hope you're enjoying the series so far. Up next on the program, Max 7 earnings in full swing.
The next few weeks, this is a get out the popcorn moment for tech. I think we sit here 4 or 6 weeks from now, look at this more of a golden buying opportunity.
That conversation coming up next, live from New York City. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks on the S&P 500 a lift here by 1/10%. There is one single name dominating the conversation. You know that name so far. It's Tesla. It's the name dominating the conversation so far this morning, at least. We're up by 11.6%. A little bit later on this afternoon, we'll be talking about Meta. Under surveillance this morning, Mag 7 earnings in full swing.
It comes down to earnings. And I think the next few weeks, this is a get out the popcorn moment for tech. And you're going to see chips, AI revolution, enterprise, consumer on the digital side, I think Google, Meta, and others. I think this is really going to be a flex the muscles moment for tech. So my view is, no doubt, white knuckles, many yelling fire in a crowd theater on tech. I think we sit here 4 or 6 weeks from now, look at this more of a golden buying opportunity.
Here's the latest this morning. The stakes are high for big tech, with Meta earnings due after the bell today. Alphabet and Microsoft reporting tomorrow. Meta shares up about 40% on the year so far, following a stellar fourth quarter. Brian Weiser at Madison and Wall writing this: high single or low double-digit rates of growth for digital advertising are likely to persist. The huge, capital letters, thematic issue will relate to the AI-based ad tools that Meta and Alphabet have launched. Brian joins us now for more. Brian, let's start with that launch. How important is that?
I mean, it's massive.
What is it?
Well, okay, so you've got two main products. There's one called Advantage Plus that Meta has, and then there's Performance Max that Google has. I mean, they went from nothing, Meta in particular, from nothing to $10 billion run rate, $2.5 billion, in the third quarter alone. They haven't disclosed a subsequent number, but it's a massive shift in terms of how much revenue they're getting.
Can you tell me what it does?
It just automates everything. It automates the creative, it automates the placement. You just set it and forget it.
So how much are we looking at a much stripped down staff? Basically, are you expecting some sort of mass layoffs in addition to everything they've already announced?
Yeah, I don't think that happens because I think people find new ways to add value to the process. But the point is they collect more revenue. The money is there, right, in terms of what the advertiser's willingness to spend is. You plow more money into engineering, more money into data centers. If you're the marketer, you spend more money into other forms of building ideas and prompting. I mean, AI still requires people to know how to use AI. So it's not like it's not massive labor changing.
So there are a lot of questions with Meta. Usually people are looking at it as an advertising story. There's a question of just how much share they're gaining. And this year it's going to be very much about whether they want to bid for TikTok and what they expect to see in terms of ads from that. What do you expect to hear on that?
Well, I think a lot of people are going to wonder about TikTok. I don't think we'll hear anything about it. First of all, my view, I think when we keep speculating about who's going to buy TikTok, my bet is that the Chinese government won't even allow them to sell it. So I think you're more likely to see an exit of the market. The question is really what happens to all the $6 billion last year, let's say, of ad revenue that was going to TikTok, and maybe $8 billion this year. That money will get redistributed, right? Some of it will go to Meta, some of it goes to Snap, some goes to YouTube. But I think that they'll look about how they can make products that capture the revenue, a disproportionate share of that revenue.
But isn't Meta in the best place to bring in those users? Because you already see TikTok videos, basically hand-me-downs, live on Instagram.
They're in a really good place for it. But you have to remember that so much of TikTok is video-based, so YouTube's in a really good position for that too. Snap also, really good position because it's a similar audience.
I also want to ask you about advertising when it comes to China. RBC is talking about potentially it can wane in China, and this is where they have this incredible demand in terms of the advertising. Do you see that? How difficult is that going to be?
Well, let's clarify. You mean Chinese marketers advertising abroad, which is a thing I've been harping on for a decade. Yeah, it's hard to say. I mean, the weaker the Chinese market gets, the more that manufacturers there focus on markets abroad. It's a negative correlation between economic activity and advertising. This flips the conventional view about advertising and economics.
What does the death of TikTok look like? Can you walk us through that? What would it look like? Do they just do this through the App Store? How does this actually take place?
We can look to India, right? This happened already, right? You literally one day it's just no longer available. And new
but
things
people
pop
can
up.
still use it, even though it's no longer available.
That's my understanding, but I don't really know. This is sort of how do you tell the app stores to stop supporting it? The second you need an update, it stops working, right?
Well, which raises the question of how they're going to capitalize it and the products that they might come up with to try to get some of those eyeballs. I am curious about the advertising picture, where that often is a sort of macro call on how companies, how confident they are about economic strength going forward. Does that still apply?
No.
Okay, why?
No, because, I think that there's these old rules of thumb that were informed largely by a predecessor who I replaced, worked throughout the second half of the 20th century. He basically taught everyone how to think about advertising. And what he taught everyone in the 1950s, 60s, 70s, 80s, 90s was correct, that there was a very direct relationship between economic activity and advertising. but it's kind of falling apart because you have this cross-border activity for starters. The other thing that people don't appreciate, e-commerce-based marketers spend $4 for every dollar of revenue relative to what a traditional retailer spends. For every dollar of revenue they spend on advertising, the e-commerce-based companies spend 4 times as much. So as the economy shifts to digital, there's greater ad intensity. And that's another factor that kind of distorts this relationship.
You know, I have to go here. The chain, Mark Zuckerberg's chain. Because it goes to this question.
He's trying it out.
Well, he's trying it out. It has a prayer message written on it that he wants to sort of pass along, that he reads to his kids at night, and he's starting his own fashion line. I guess I'm going to this point of the cult of personality.
Yeah.
And the questions around personality, and some of these founders of these companies, whether that's an attribute or a deficit or detriment going forward.
Attribute.
Okay.
Oh,
so
yeah.
even for Mark Zuckerberg, who has, you know, there are people who might see the chain and they might really want it, and there might be people who see the chain and say, okay, it's kind of a, you know, bit of a parody.
Vibes matter. I mean, at the end of the day, whether it's politics or advertising, especially advertising. Now, you're not going to get a better AI-driven advertising campaign because Mark Zuckerberg has a more fashion sense. But keep in mind, what really matters, back to the whole, like, what do people do in an AI-driven advertising world? There's still a subjective choice about why do you allocate more money to Meta versus Google?
Personality matters. I agree with you. Mark Zuckerberg has not got a fan in Donald Trump. Can we finish there? What does that look like if Donald Trump goes back into the White House? It's pretty clear. He can't stand the guy.
Yeah, I mean, I don't think it'll really impact advertising in a meaningful way. I mean, at the end of the day, it's...
Does he have the power to reverse the TikTok decision? Would he put that back on the table? Would he push Congress to reconsider everything? I'm just trying to work this out, what this actually looks like. How much power does he have?
I think the bigger issue is going to be what happens to the rest of the advertising industry. So, for example, broadcasters, right, TV network owners, what kind of regulatory latitude do they get? Because, frankly, I don't want to say they've given up, but they haven't done anything near as aggressive moves as they could take to become a more powerful player with respect to advertising in this world. Could they be loosened up? But again, Lena Khan probably stays in the FTC, no? In which case, maybe nothing happens.
Do you think if Trump wins, she stays in the FTC?
I don't know. Doesn't she seem to be satisfying what...
Well, his potential VP pick likes him,
Yeah, there's a lot of Republicans that agree with what she's doing. Brian, thank you, sir. Brian Waiter there of Madison and Wall. Meta coming a little bit later following Tesla yesterday afternoon. Coming up next on the programme in the second hour of Bloomberg Surveillance, we'll catch up with Laurie Heinel of State Street, Henrietta Trays of Vader Partners, Bloomberg's Brooks Sutherland, Mike Schumacher of Wells Fargo. Mike Schumacher's got some strong thoughts on this bond market. The Fed is easing soon playbook. Remove it from your desk and put it on a distant bookshelf. He does not think those cuts are coming anytime soon.
Which is the reason why you have this big push-pull, and it just takes one weaker than expected S&P Global PMI print for people to go back to the rate-cutting story. And then, you know, does that reverse when we get something else?
We'll talk about supply as well, just for Bramo. Strong two-year yesterday. More supply coming a little bit later. Bond yields higher by 3 basis points. The 10-year 464, the 2-year up by 3 to about 494. From New York, this is Bloomberg.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to
be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All of the things that we would look at from an early cycle perspective are just not there.
I think the big driver here is, does inflation come down as much as we anticipate?
Pretty convinced that inflation is not returning to 2% in any kind of stable, reliable way.
Overall, inflation is just going to be more elevated than we thought.
And that's the big question for us right now, and I think for the market. Is what we've seen inflation that's sticky, or is it truly reaccelerating?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Big tech earnings underway. Tesla behind us, in front of us, Meta, then on to Google and Microsoft. Next week, Amazon, then on to Apple, Nvidia later on in May. From New York City this morning, good morning, good morning. Your equity market positive by 0.1%. Tesla in the pre-market absolutely flying, up by more than 12% in early trading, up by about $17. The latest from Dan Ives, bit of a price target cut, down from 300 to 275. But he says this, Bramo, in a much needed call, Musk stepped up as the adult in the room.
Which is exactly what you expected him to say at a time where a lot of people are saying tone matters for someone who is thought of as somewhat of a genius, but also pretty unpredictable when it comes to performance. The key question for me is, how much does this set up this earnings period to be more of a tell me rather than show me, right? We were thinking this is going to be a show me quarter for a lot of big tech. It seems like tell me is just good enough for Tesla.
It's that carrot dangling in front of you right now, a carrot or a mirage. I guess we're going to find out in 2025, because the low-cost EV apparently is coming to you at some point in 2025.
Elon Musk was asked about this a lot, and he continued to brush off these questions, and he said more on that August 8th. And I thought he was just obfuscating, because this is what the market wanted, and he wasn't prepared to go in all those details because he really had this Hail Mary idea of the robo-taxi. But Pierre Ferragu said, well, if you have an iPhone and you're prepared to launch it, why would you spill the beans and give those details away? So potentially we will learn a lot on August 8th, which is why the likes of Dan Ives are saying dark days potentially behind us, and we're looking forward.
We'll see. We'll see if this puts a floor under this stock, because this stock has had a terrible year so far. Coming into these numbers down by more than 40%. We need to talk about the latest down in Washington, D.C. as well. It was almost unthinkable a few months ago that we've actually come to an agreement on foreign aid for Ukraine, Israel, and Taiwan. The number $95 billion aid package getting through Washington.
It's getting through Washington. When the president signs it today, he did insinuate last night in a statement that he will make a speech to the American people. Already what we've heard from officials is that they already been preparing, especially for Ukraine, to get that ammunition and those weapons out the door, because right now Ukraine is suffering deeply, what you hear from Zelensky and Ukrainian officials on the battlefield, and they think this next aid package can change.
It also opens up the door to what's next, right, in terms of the discussion points heading into the election. This was a big one. This is really important. Come together, do something. Okay, they got that done. You got to fill, what, 6 months now of rhetoric? So we have to figure out what's going to be the leading story, because that seems like that's the way of the moment right now in Washington, D.C.
Well, when it comes to a budget, they're just going to punt that. Everything they potentially have to do before the election is going to be kick the can down the road, and it's just going to be a lot of electioning. It's an election year.
Electioning.
Electioning.
Okay, lots of electioning coming to a TV set near you over the next 6 months or so.
Wonderful.
Thank you. Equity futures right now on the S&P 500 positive by 0.1%. The stage is set as follows. Going into Meta earnings a little bit later. Yields are higher by 3 or 4 basis points on a 10-year 463.55. Coming up this hour, we'll catch up with Laurie Heinel of State Street with stocks building on 2 days of gains. Bloomberg's Brooks Sutherland reacting to Boeing earnings out a little bit earlier, a little bit later this morning. Mike Schumacher of Wells Fargo not expecting rate cuts anytime soon. Look out for that conversation a little bit later. We begin with our top story. Stocks bouncing back. Tech driving the S&P 500 to its best day in 2 months. Laurie Heinel of State Street with a warning right in this. Equity markets will remain challenged with continued influence of still high rates, stubborn pockets of inflation and mixed economic data. Overall earnings growth is improving, but individual sectors are vulnerable. Laurie joins us now for more. Laurie, is this a scream to buy bonds and buy bonds right now?
Well, hardly. We still think that there is room to run in equities, particularly U.S. equities. Earnings continue to come pretty good. But it also means that we're holding elevated levels of cash, in part because we do think that there's value there when you have interest rates where they are. But also we want to retain a little bit of dry powder so that we can capitalize if we get more pullbacks.
We got a scent of economic weakness yesterday, just a little scent of it, but it was enough to really push into a bid into the bond market. Do you think that PMI is actually worthy of giving a double take? Would you put much weight on it, what we heard yesterday?
Well, as you know, our view has been that we actually think that the inflation boogeyman is more or less contained. Now, that doesn't mean that we're going to see, consistent 2% levels of inflation anytime soon. But we're really concerned about the fact that the Fed remains so focused on data by data by data, and that there's a lot of noise in the data right now, and actually markets are having the same sort of reaction. So we're not hanging our hats too much on any one point of data, but it's really about trend lines. Where do we see the trajectory going, and is it durable?
One thing that you said was that you have higher than normal cash holdings right now at a time where you do have a relatively high rate for that investment. Are you worried about reinvestment risk? Are you worried about the idea that if that weakness that makes you less optimistic about risk assets comes through, that the Fed would cut rates and would actually make it less attractive?
Well, certainly reinvestment risk is always on our mind. And as you know, our forecast is that the Fed is actually going to cut this year. They may cut as many as 3 times or perhaps move for, 100 basis points or so. But what we also believe is that it's going to be more elongated than what market participants thought just 6 months ago. So we've seen the number of rate cuts come down pretty dramatically. We've seen forward rate expectations rise. So you actually are getting paid to hold cash. We don't think that the amount of cash that we're holding is, particularly high. I mean, 7% is a nice position, but it's hardly going to, take away from the core portfolio. But the other thing is we do think we'll have more time to reinvest that cash over time than we thought even at the beginning of this year.
So how much of a pullback in equities before you start seeing that as attractive?
Well, certainly we'd like to see another 5 or 10%. Those are the sort of levels that give you encouragement that you're going to have a better risk reward. We don't expect to see that in the near term, in part because we think earnings are going to come through pretty well. But of course, there's a lot of volatility out there. Equity volatility has been heightened more recently, and we have actually paired our overweight to equities as recently as early this week.
Given all this volatility, I know you hold a modest position in gold. What would it take for you to want to sell that?
Yeah. Well, first of all, some of the volatility to come down. I think one of the interesting parts about our position in gold right now is it's not necessarily driven by the typical reasons that you allocate to gold. Normally you think about deflationary environments, inflationary, hyperinflationary environments. Those are good places to hold gold as a diversifier. Rather, part of our positioning right now is that gold is one of those diversifiers that is still zigging when other things are zagging. We've seen heightened stock bond correlations over the last couple of years. So gold is one of those positions that actually gives us an anchor. So what we would be looking for is more normalization in the correlation across equities and fixed income.
Lori, what do you give this insatiable demand we've seen in gold and this rally we've seen in this asset?
Well, interestingly enough, one of the biggest purchasers of gold in here has been central bankers. So there is a kind of other dynamic that's going on right now, but it also, we see it's a bit of a momentum trade. And so we do think it has a little bit further to run. So again, in the context of what's going to move differently from other parts of your portfolio, gold gives you that really interesting ballast right now.
Laurie, we had a guest on yesterday. In fact, it was Mike Wilson of Morgan Stanley, who was talking about concerns about the deficit. Not alone, we've heard that a few times, and connecting the dots from that to gold. How much weight would you put on that?
Well, I think it's less about the deficit per se and more about this idea that, the dollar likely will go lower at some point in time. Now, again, typically you don't see the kind of gold run that we've seen when you have a strong dollar environment. But a lot of people, including us, are a bit skeptical that that can continue. Now, in the short term, look, there's a great bid on the dollar in the short term. Economic uncertainty creates that. Concerns about, volatility because of two wars that we've got going on. Concerns about, other central bankers moving quicker than the Fed. And so that sort of puts a bid under the dollar. But longer the we think the next trend in the dollar is definitely lower. And that should, again, continue to buoy gold.
Is that because you think there are limits to that central bank divergence story that so many people have piled on in the last few months?
Well, it's not that there are limits, but it's a question of sequencing, right? So, historically, the Fed has been one of the first movers from a developed market standpoint in terms of reducing rates. And it's likely this time around that won't be the case. So again, that gives you a bit of a dollar bid because you have higher interest rates, relative interest rates compared to other parts of the world.
I was really interested in Lori Calvasino. She came out of RBC Capital this morning with a report about some of her industry analysts and how 73% of those in the United States think that the U.S. election in November is going to be relevant to their industries. How are you figuring out some sort of investing thesis, at a time where there is this degree of uncertainty headed to markets later this year?
I think that's the $10,000 question, right? And I think, first of all, you go back to first principles, right? So earnings growth does drive equities. So where are there earnings that are likely to come through, where are earnings expectations going to be met? And so the U.S. continues to be the best looking house on a fairly bleak looking street. The second thing is hold higher levels of cash. That helps you on the volatility level, helps you with the diversification. Look for the diversifiers like gold. And then, as you say, I think industry by industry, there will be potential repercussions depending upon which candidate actually ultimately becomes president. And so if you look at things that have been sweet spots, Inflation Reduction Act spending, CHIPS Act spending, some of those things may be scrutinized by the next administration. So I think you do have to look industry by industry. The problem is it's a little early for that because we don't really know how this thing is going to play out.
We've heard that a few times too. Can we just finish on tech? Laurie, we get Meta later on today. As you know, a lot of people have just piled in 7 names into one theme, Mag 7. Story kind of worked last year in a big way. And then this year, things started to break down. Laurie, what do you think is the best way to think about those big tech names?
Well, first of all, you have to take them one at a time. You can't just lump it all together and say, let's just buy those 7 stocks and call it a day, because as you noted, wild divergence. But we've always been more in the camp that we thought that you don't want to chase those names even collectively. Have a much more diversified portfolio. We do think that as the market, continues to see its legs, you'll see broadening out in the market, and that's going to benefit investors.
Laurie, appreciate your time this morning. Laurie Heinel there of State Street, following earnings from Tesla. Later on this afternoon, we'll hear from Meta. Then on to tomorrow, you'll get Google and Microsoft. Next week, Amazon and Apple. The end of May, near the end of May, May 20-something. I think May 22nd, you'll hear from NVIDIA. Equity futures on the S&P positive here by 0.1%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Ryanair CEO Michael O'Leary weighing in on Boeing's management crisis. O'Leary saying the plane maker needs to focus on leadership, continuity, as it seeks to stabilize its business.
We're seeing optimistic signs. I mean, we've seen aircraft now being pulled from the hulls, being moved from Wichita to Seattle, but without any defects being carried over. I think that's a good sign. It'll speed up the manufacturing process in Seattle, and I think we're now getting, with the new management team in place, I think we're going to hopefully see the end of these production challenges in Boeing.
Boeing is set to report earnings in just under 30 minutes' time as it faces ongoing regulatory scrutiny. That stock is up at a pre-market by a little more than 1%. Elsewhere, talks to resolve a standoff between pro-Palestinian demonstrators and Columbia University officials have been extended after a deadline expired at midnight. The Columbia Spectator reporting that the two-day extension came after significant progress in discussions, student representatives agreeing to 4 commitments, including cutting down on tents in their protest encampment. House Speaker Mike Johnson is set to meet with Jewish students at the university a little bit later on today. And finally, Kering shares falling to their lowest level since 2018 after the luxury group warned of a profit plunge in the first half of the year. The company blaming slumping sales at Gucci, its biggest brand. Shares are down 20% so far this year compared to gains elsewhere in places like LVMH, which is up something like 10%. If you missed it earlier, an absolute clinic on what Gucci is going through from AMH a little bit earlier. Do you want to repeat that clinic?
This time, there's a lot to dissect here.
The design problems, the obstacles going forward.
It's a different creative director. It's a new vision.
A new vision. What is that vision now?
It's definitely a little bit more sleek. His first runway show was a gray overcoat. It wasn't the extravagant, in-your-face, loud fashion
like
of Alessandro
oversized?
Michele. It was more sleek. Think vintage Gucci.
Okay.
And the consumer base is different. They need to shore up some new clients.
The numbers out of Gucci just absolutely terrible. Sales of Gucci down 18% in the first quarter, held back by China. Up next on this program, less on Gucci, less of that stuff. The Senate passing the foreign aid bill.
After more than 6 months of hard work, many twists and turns in the road, America sends a message to the entire world. We will not turn our back on you.
That conversation is just around the corner. Live from New York City this morning. Good morning.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been? Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
The bounce continues. 2 days of gains on the S&P 500, up just a little bit, up by another 0.1% on the S&P. Yields drifting higher once again, up by 4 basis points, 464.17. Under surveillance this morning, the Senate passing the foreign aid bill.
After more than 6 months of hard work, many twists and turns in the road, America sends a message to the entire world. We will not turn our back on you. Failure to pass the supplemental would have been a gift to Putin, to Iran, to Xi, and hurt America politically, militarily, economically, and culturally.
Here's the latest. President Biden set to sign a $95 billion aid package for Ukraine, Israel, and Taiwan after the Senate passed the bill just last night. Biden's signature will also start a countdown on TikTok, the social media app facing a possible ban in the U.S. unless its parent company ByteDance divests within 270 days. Henrietta Trace of Vader Partners joins us now to break this down. Henrietta, before we race off into the detail, I just want to sit on this just for a moment. We've talked so much about the division down in Washington. Only a few months ago, some people thought the prospect of this happening was almost unthinkable. Just how united did Washington become on this issue in the last few months?
They gained, I want to say, 8 votes since February from the Republican Party, who had been so opposed to providing the aid to Ukraine, Israel, and Taiwan. This is really a case of members wanting to be on the right side of history. You know, last week when Speaker Johnson said, hey, go into the sit room, look at all of the foreign intel, look at the data that we have backing this up and why we need aid to Ukraine. We need America to be strong against Putin and Xi and Iran. And that is exactly what the members decided to ultimately deliver. I think this is a testament to the foreign policy arm of Joe Biden's career in the Senate as president, obviously Chuck Schumer, but in no small count, it's Mitch McConnell who wants this to be his legacy, which is something we've been hearing from staff for 7 months since the October 7th attacks in Israel and well before that in Ukraine.
But Henrietta, this got through without border policy, which Republicans were basically promising their caucus that we would make sure we would do. Where does that leave that potential legislation? Or is this just 100% become an election issue and no one in Congress is going to work on it until maybe next year?
Congress is definitely not going to be able to do anything on the border. Republicans had their chance. They decided it wasn't good enough. They let the perfect be the enemy of the good and all the cliches that we hear from Lindsey Graham repeatedly on issues like this. And we haven't passed immigration reform in decades. I still remember 2013 when we came so close. They do not have the ability to get to yes on immigration. But the administration is planning a series of executive orders on border policy, which we'll see potentially as early as next week. So I expect that to be the bulk of what we do on foreign policy, on border security in this Congress.
And of course, that's going into the election. We have a new poll out this morning which shows that Biden bump he had following the State of the Union has evaporated. He really only has control right now of Michigan, and it continuously comes back to the economy, especially inflation. What is the messaging from the White House going to be? Because it's not landing on voters.
You know, the economy has been a weak point for President Biden for many years now. One thing I'd really point into your polls, which I think have an incredible margin of error of just 1%, you know, speaking to the testament of how thorough your polls are of the swing states. Michigan is an interesting one. Obviously, President Biden has made huge efforts to get with the union groups on that. He got another endorsement today. But Kennedy did get on the ballot in Michigan, which is potentially going to be a problem for the Biden team and the Trump team. But when it comes to the economy, the president has had an underwater dearth with women voters, female voters, specifically because of their exposure to inflation and the cost of household goods and gas prices, which are a disproportionate share of where money is spent in America from the women of the household. And that delta is potentially being superseded by the abortion issue, which for the first time in your poll is now a major issue, very important to a majority of voters in those swing states. That includes Democrats, independents. And what we saw from 2022, if we want to learn from something beyond just the polls, the actual boots on the ground, that issue has a history of superseding even the economic issues and inflation, as we saw in 2022, when inflation was even higher at 9.1%. So I do think that it is going to be a situation where Biden keeps having to tout the state of the U.S. economy, which is by all accounts strong, which is why the Fed is struggling to, cool it enough to bring inflation down. But really getting that message across, I think something that's occurring is they're trying to two-step it with abortion. I'd like to see where immigration falls in the polls when I get a chance to read a little deeper into it. That's also something Republicans want to seize on, but the economy continues to be paramount.
Henry, we were saying that now that this $95 billion bill was passed, there's a question of what next? What gets done before the election? Anne-Marie, well said. Electioning will probably get done, not a whole lot else. You talked about the potential for some sort of single executive actions on the border issues. What about tariffs? What about other issues that might come to the fore, including from the FTC, that very much are in line with what Biden has been talking about?
Oh yeah, I'm finally expecting for tariffs and trade to be front and center. Ambassador Tai was on Capitol Hill last week in the House and the Senate side, and there were some major announcements. 3 times higher steel tariffs, which is only about 2% of U.S. imports, so don't expect that to be a major mover for steel prices in the U.S., but directionally and from a sort of messaging standpoint on China, very important. And the new Section 301 investigation into shipbuilding, which is an area that the United States is way behind on and China dominates with, and then a coordinated effort with Mexico and potentially also Canada via the new USMCA that Ambassador Tai was integral in getting passed during the last administration, could be used to look into electric vehicles, their import from China on the component side, and sort of preemptively getting in front of that entire sector. So I think a lot of activity on trade. And then, of course, we are eagerly awaiting a conclusion of the Section 301 review, which covers the $370 billion worth of tariffs that are currently in place. And by the end of next month, Ambassador Tai will announce which and whether any exclusions that were agreed to in the last year will be extended. So lots of movement on the trade front. But to your point on Congress, don't expect anything. They're going to be gone campaigning for the rest of the year.
When it comes to the trade front, you mentioned steel, I think Pennsylvania. You mentioned potential EVs on Chinese tariffs. I think of Michigan. What lever could Biden pull before the election to shore up votes in Wisconsin if he has to keep the blue wall, which Mario Parker, our colleague in Washington, says he has to keep the blue wall to win?
You have to keep the blue wall. You really want to see the heartening part of the data for the Biden team in your poll this morning is Michigan, where he continues to maintain his lead, even though he's underwater everywhere else. I would also say the primary vote in Pennsylvania last night is really interesting. Nikki Haley, who hasn't been on the ticket for months now, got 17% of the vote. So I think what Biden is going to do is try to continue moving forward with the steel workers. Again, that 3 times higher steel tariff is something that he is calling for that speaks directly to the steel workers. And what we know about the unions, the Teamsters, the steel workers, and all those groups is that they will go to the mat to get their 250,000 members in any individual union to vote in the direction that they're advocating for. So I think that Biden is really taking that labor message to heart, which is integral in Pennsylvania, Wisconsin, Michigan, and the whole Rust Belt.
Henrietta, you are one of the best. It's great to catch up with you. Henrietta Trace there of Vader Partners, breaking down the situation with our polling and what we've seen overnight in the Senate. AMH, this is something that Henrietta's done a brilliant job of over the last few months. Just how deep is that pool of people who just have not decided what they will do come November?
There are a lot of them. And something else in our poll that I find striking is the fact that Biden's 6-point deficit across the swing state even wider than that of Democratic congressional candidates. So can you see these split ticket individuals say, actually, we don't like Biden, but I like my Democratic congressman or woman, and I'm going to vote for them. So when it comes to these double haters, the issue is, where do they go, or do they split their ticket and potentially give the other side their presidential vote?
It's going to be a fascinating 6 months ahead. Equity futures right now on the S&P 500 positive by 0.2%. Tesla doing nicely in the pre-market. More earnings still to come. And a little bit later, you're going to hear from the likes of Meta after the bow. Before the opening bow, you're going to hear from Boeing. Earnings dropping any moment. We'll catch up with Bloomberg's Brooke Sutherland, who joins us next to react. From New York City, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Coming off the back of the biggest one-day gain, going back about 2 months, 2 days of gains into today. Equity futures positive by another 0.2%. A little bit better on the Nasdaq, up by 0.6. Supporting that story, Tesla out overnight, up in a pre-market by double digits. We'll talk about that name in just a moment. Let's talk about the bond market. Lots to discuss. Solid 2-year issue just yesterday at the front end of the curve. $69 billion worth. Later, huge numbers, $70 billion of 5-year notes coming to market. Yields are higher going into it by a single basis point. A 2-year, 493.93. On a 10-year, up by 3 or 4 basis points, 463.76. What was interesting, almost amusing, was how encouraged people were by the softer PMI we got yesterday morning.
It confirmed the belief that some people have that data is going to weaken, and that was enough to give them confidence to go into that 2-year auction and absolutely hoover it up, right? I mean, this is essentially what people were worried about, is if you get a weak auction, how much does that filter into the rest of the market? What's interesting to me is just how much that's the tail that's wagging the whole market's dog, right? Basically what you have is stocks willing to rally if bonds rally. But if bonds sell off, stocks don't know what to do. So there is still a bias right now underpinning the market of a soft landing and, frankly, of a pretty bullish sentiment.
That's the market. We're tracking earnings this morning. Boeing has just dropped. We'll work through the details and we'll bring them to you when we get a clearer picture of what the company's telling us this morning. Let's turn to foreign exchange. Story in euro dollar. Dollar yen looks like this. We're negative by a tad, 1/10 of 1% at 106.85. Dollar yen 154.91 came really, really close to 155 overnight. We're up by 0.05%. The threat of intervention, I don't know, can you make the argument it's hanging over this currency pair when we went through 152, 3, 4 and approached 5 in just a few weeks?
I mean, arguably, you could say that people are questioning their ability to interfere. At this point, you have to wonder, okay, is it not just at 160 because of the threat of interference, right? I mean, the bar has gotten reset so many times. Right now, what I'm looking at is how much is the Bank of Japan and, frankly, potential foreign intervention waiting for weak prints in the U.S. to do anything, because this is a fundamental story, not one particularly of whether they buy the yen or not.
Just a little more yen weakness on the screen today. Out of surveillance, your top story, shares of Tesla flying in the pre-market. The company accelerating plans for a cheaper EV model, which could be available by the end of the year. The announcement overshadowing worse than expected revenue and profit. That name is positive in the pre-market by double digits. Elsewhere, in Washington, President Biden set to sign a $95 billion aid package for Ukraine and other allies, allowing arms shipments to Kyiv to resume within days. Biden's approval also starting a countdown for TikTok parent ByteDance to divest the social media platform within 270 days. I guess you can say my work here is done. I've done my bit. And finally, let's turn to Boeing. Earnings crossing just moments ago. First quarter revenue beating Wall Street estimates. The CEO, Dave Calhoun, saying the company is likely to deliver its 737 and 787 inventory by year end. That stock is higher. Initial reaction, we're up by almost 3%. Brooke Sutherland of Bloomberg Opinion joins us now for more. Brooke, you've had a few minutes to go over this one. What stands out for you?
I mean, I think what's really striking is you look at in the quarter, those commercial airplane deliveries were down 36%, and that just speaks to how slow Boeing is going right now as it tries to finally get its arms around its quality control issues and make sure that the FAA is satisfied. But if it's not delivering planes, then it's not collecting cash on those aircraft, and that's why you're ending up with this negative free cash flow in the quarter of about $3.9 billion. Now, that could have been worse, quite frankly, and it's certainly positive to hear Boeing talking about being able to clear out its inventory by the end of the year, but I think that remains a bit of a prove it story. At this point in time, we still need to see the results of Boeing's action plan in response to that FAA ultimatum to come up with some sort of plan to finally, put an end to these quality control issues. And I think the FAA is really going to be the gating factor here in terms of Boeing's ability to meet those goals.
Demand isn't a problem. They're talking about the new net orders, 125. Demand hasn't been a problem. It's never really been a problem over the last few years, Brooke. It's quality control, to your point, and now it's about production, their ability to meet that demand. Brooke, has it interested you at all that demand hasn't fallen off in a material way, given how much this company has been in deep water over the last few months?
Well, I mean, I think if you look at its market share relative to Airbus, it is losing. And Airbus has built up a pretty substantial lead, particularly in the narrow body market. And so in terms of that competitive dynamic, it is much more lopsided than it was just a few years ago. But the reality is you have a duopoly. And if you are an airline operating in either Europe or the US or really any part of the Western world, your only choice is Boeing or Airbus. And it's not in the airline's interest to put all of their orders on Airbus in terms of pricing dynamics, and also in terms of just being able to get those airplanes, because Airbus is sold out well into the next decade. And I think that's, if you look at Wall Street analysts, and a lot of them are still very positive on Boeing stock, not because, the current situation is so wonderful, but just because the reality of the aerospace market is that that demand is going to be there for Boeing. Boeing is not going to be allowed to fail. It is the biggest U.S. exporter, and the airlines and much of the world really depend on this company to finally figure out what is going on and be able to hand over airplanes that are to the quality that airlines expect.
But can it turn a profit? Boeing shares are down 35% so far year to date, which is a reason why a 3.2% pop looks significant, but in the scheme of things, maybe not so much. Brooke, what optimism can you glean? Just simply that there could have been a worse negative adjusted free cash flow number, or is there something else, either a NASA contract or some sort of sit-ins of safety patrol that you've been hearing about with certain employees?
I think in terms of the question of when will they turn a profit, I don't know if that's the right question right now. And I don't really think that investors want to hear that from Boeing, which sounds weird to say, but the best way forward to rebuild profitability and free cash flow is to get to the bottom of these quality control issues. And that happens by going very slow, being very meticulous, getting in on the factory floor, figuring out where the problem points are and really solving them one by one. And I think the optimism is around the fact that Boeing seems to finally understand that. Now, you could argue that they probably should have understood that after the two 737 MAX crises, but they seem to get it now. They seem to be taking it seriously. Of course, they also announced that leadership transition with CEO Dave Calhoun set to step down by the end of this year. We don't know yet who is going to replace him, but they're at least saying the right things right now, which I think is progress.
Honestly, this just rhymes so much with some of the analysis of Tesla that basically the two laggards came out and said the right thing, and that was enough for people to buy into this story. Is it enough for you? Is it basically enough that this is a leadership team that understands that it needs to be saying safety is first, even though literally everybody has been saying that for the past 3, 4, 5 months?
To your point, yes, I think the bar is rather low here. And like I said, they're in the prove it moment, that it's good that they're saying the right things, because they haven't always been doing that. There's sort of been this undertone of, no, we don't have, a culture problem, and this is not some sort of comprehensive issue. It's just sort of one-off quality control issues we have to get our hands around. And they've started to move away from that, which, acknowledging that I think is an important first step. But you're exactly right, that it really comes down to, can you build up a track record where airlines are receiving the quality airplanes that they have ordered, and they're receiving them on time. And I think that just is going to take a couple months here, and Boeing really needs to work its way through its issues.
Brooke, where is Boeing when it comes to buying back Spirit Aerosystems, this company they used to own?
You know, it's interesting because I think there's a lot of urgency to try to get this deal done and to bring Spirit back into the fold and help stabilize it. But this has been taking a bit longer. Now, there was some news yesterday that Spirit actually announced Boeing is advancing it $425 million to help stabilize its operations. This is certainly not the first cash advance that Boeing has made to Spirit. It has a lot of its own staff already in Spirit's factories, and that's partly why I'm somewhat skeptical that this acquisition is going to do all of that much to really rectify the issues with Spirit and Boeing's supply chain. But at this point in time, they're still working through their math on that deal.
But what about Spirit's supply chain? Because they also have Airbus as one of their customers.
Right, which is a complicating factor, and this would have been a lot easier, you know, if Boeing had attempted to repurchase Spirit, you know, a decade or two ago. But now Spirit has tried to diversify, partly out of necessity, because it was not healthy for this company to be so dependent on Boeing. And so they do have contracts with Airbus. They also have defense contracts. Now, those are not entirely profitable contracts for Spirit, but they do exist, and those companies rely on Spirit as a supplier, and they're not going to be keen for some sort of arrangement with Boeing that doesn't satisfy their interests as well. And that's partly why this is so complicated and why, you know, some analysts in the past have expressed skepticism about any kind of Boeing takeover of Spirit, just because this is not an easy deal to get done, and it requires a lot of carving up of assets.
Hey, Brooke, appreciate the breakdown this morning. Brooke Sutherland there of Bloomberg Opinion. Boeing, if you are just joining us, first quarter revenue, $16.57 billion. The estimate, $16.25. The stock is higher in the pre-market by something like 4%. Bramo, I think you're right. Kind of rhymes with Tesla for a few reasons. Here's another one. Year to date, absolutely hammered. You can't look at this move unless you look at it relative to where the stock has been over the last few months.
So it raises this question in my head. Is the bar different for different companies, right? Because they've been the two biggest laggards on the S&P 500, are you looking at a bar that is lowered substantially? And even just good talk is enough to get this over the finish line and get a bit of a rebound versus companies that have done very well. And even if they beat expectations, we've seen sometimes an underperformance. Again, it highlights how difficult it is to come with any overarching narrative for this earnings season, even though, you know, we're trying to find those themes. Mike Wilson, I said it best yesterday.
You nailed it, yeah.
You know, keep humble, keep nimble, keep looking at each story and figure out kind of where each one is going to go.
And Mike said what we've said a million times on this program. You can learn something from the information and how the market responds to it. Makes me think of Apple next week. How low is the bar for Apple next week? The numbers we've seen around this company, down double digits year to date. We've had warning after warning in China. Research outfit after research outfit come out and say how weak earnings are in a second largest economy. How low is the bar going into next week?
Which is the reason why some people are expecting some kind of pop in the shares, including Bank of America. This is the issue, right? What will it take? Is it just sort of rhetoric in terms of either a lower priced model in certain areas, expanding in India? What kind of advertisement campaigns they're going to do in China? Are they going to move away from China? Those are some of the questions I think are going to be really interesting.
Futures right now positive by 0.2%. Let's give an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Gold's record-setting rally this year has left market watchers puzzled, but the answer may lie in China. Prominent figures in the global gold market coming to the conclusion that retail investors on the Shanghai Futures Exchange are helping to boost prices. China is a top gold consumer and producer. The country has a long-standing history of using gold as a savings tool. Gold soaring this year, topping 2K an ounce in the face of headwinds that would normally cap any gains. A second story, the FTC voting to adopt a near total ban on non-compete provisions that prohibit workers from switching jobs within an industry. The Chamber of Commerce vowing to immediately challenge it in court. The legal showdown comes 3 years after President Biden signed an executive order encouraging the FTC to limit non-compete agreements, which affect roughly 1 in 5 Americans. The rule does not apply to existing non-competes for executives who earn more than $151,164 a year in a policy-making position. How did they come up with a number like that? Where's that from?
Gotta be accurate.
I mean, come on. How did they come up with that? And your final story, the NBA's exclusive negotiating period to discuss a new broadcast deal with Disney and Warner Brothers has ended. Opening up the sport to potential new bidders, the NBA will continue to negotiate with current partners, but could look to expand its broadcast deal to include streaming-focused services such as Amazon or Apple. The league's current 9-year deal is worth around $24 billion, with the NBA looking to double that this time around. I just want to know what channel to go to for what sport. It's
I
like
know, we know,
spread so
we know what you want.
thin.
I
Doesn't
know.
matter
So you just want a
what
bundle.
sport it is.
You want it to go back to the future, which is basically
Sure,
have a
I
bundle.
just want to know,
go.
pick one.
What, do you want it just like a search function?
No, yeah, that would do.
You
That
think
would
so?
do.
Just
or
to be
just,
able
or
to
just
search
the
it?
algo at this point should know, right?
Obviously.
Like Amazon.
Versus Farmer and Son
Amazon
or
at this
whatever.
point knows everything
Farmer's
about
wife. Farmer's wife, excuse me.
Great show. Great
American
show.
Idol.
Fox, good show.
Bachelor. I mean, honestly,
You've
to
been
be
watching
fair,
Idol too.
whatever.
Yeah, there you go.
I don't watch
What are you
any
throwing
of
mud
this.
for?
What are you guys doing on the weekends?
No, honestly,
Bramo likes to chill. This is how she chills.
I also look at puppy videos.
Do you?
Oh, totally.
Dog videos.
Yeah, all the time.
True story, okay? Show's going. TK's going off on one. Fiery morning, okay? Bramo's next to me, watching dog videos. Watching
Okay,
dog
look,
videos.
I can
just to
still
try
think-
and calm herself.
Look, also resurrection videos of like the dogs that are being found and they're sort of kept up and made into.
I'm
something
gonna plan
nice.
the night out for
Adopted.
surveillance.
TK having too much tang. Bramo kind of losing it a little bit, just trying to, meditate.
We all have our things.
Meditate
We
on
all
puppy
have our
videos.
issues.
Okay. Up next
Speak
on the
for yourself.
program, bracing for a hawkish Fed.
Even if you get disinflation, 3-4 months ahead, I think the Fed is going to be a little bit more reluctant to cut rates. It's going to take a while to rebuild that confidence.
That conversation on the other side, live from New York. This is Bloomberg.
On season 2 of The Circuit, we're walking with the titans of banking.
You guys love these meet and greet things. How are you?
And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money. You've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
No more of that. Equities on the S&P. Positive by a quarter of 4%.
We're going to still
no,
go
no,
there.
no.
Yeah,
We're
totally.
done. Under surveillance this morning, bracing for a hawkish Fed.
With growth as resilient as it is, with financial conditions as easy and accommodative as they are, there's really no reason for the Fed to guide towards a full cutting cycle at this point in time. Even if you get disinflation, 3-4 months ahead, I think the Fed is going to be a little bit more reluctant to cut rates because they've seen a head fake from the inflation data. It's going to take a while to rebuild that confidence.
Here's the latest. Investors are waiting Friday's core PCE deflator for hints about the Fed's path forward. Mike Schumacher of Wells Fargo writing this. Move the Fed is easing soon playbook from your desk to a distant bookshelf. The Fed needs 2 or more, likely 3, solid inflation reports before seriously considering a rate cut. One fine day, the Fed will ease, and the market will then price lots of additional easing. That's not today. Mike Schumacher joins us now for more. Mike, fantastic note. Thoroughly enjoyed it. I want to pick up on what you had to say about supply as well, because we've been very focused around this table on the slate through the rest of this week. 2-year yesterday, 5-year today, 7-year tomorrow. Do you think the supply deluge, the fireworks, are in the rearview mirror?
Just about. Yeah, it's interesting. You've got the announcement coming out next week. Should be kind of a snoozer. So I do agree that the huge uptick in supply, it's probably done for the balance of this year, Jonathan, and maybe into next year as well. Depends on the election outcome, but probably 6+ months.
I feel seen. I understand maybe some people aren't focusing on the auctions as much as I am, but I do think it's telling that yesterday we saw such a big move in the 2-year yield, and frankly, a successful auction on the heels of S&P Global PMI data. How much, I mean, and John brought this up earlier, how much does that sort of give you a sense that maybe the playbook needs to still be on the bookshelf and having, you know, a little bit of a permanent place in your repertoire?
It's on a distant shelf. It's not gone entirely, but I think for now you can set it aside, Lisa. It's interesting. When you look at what's been driving both rate and currency markets, it's expectations for central bank policy. So the Fed, the ECB, take your pick, but that's what the markets are fixated on. You can do regressions until the cows come home, and that's what they'll tell you. You can talk to people in the markets, and that's what they'll say. So 2-year auction, interesting, but to me it's not really a signal event. So I do focus, though, on the huge amount of supply we've seen and think the market's had a tough time digesting that. I agree with that point.
What's the distinction between a Fed easing cycle and just sort of maintenance cuts, or however people want to call it, where you do get a couple of cuts this year, but it doesn't begin this sort of wholesale decline in benchmark rates?
Yeah, so just to trim around the ears, that type of thing, I suspect the Fed would have a tough time doing that. And the reason I say that is that if you think about the FOMC, when those committee members sign up for one cut, they have to assume there will be a bunch of cuts to follow. And my strongest view with respect to Fed policy hasn't changed, despite the backup in rates. And that is that, as Jonathan noted, whenever the Fed does cut, the market will price a lot more easing, but who knows when that happens to be. So committee members have to subscribe to the idea it's not just 1 or 2 cuts, it's probably 4 or 5 at a minimum.
At this point then, Mike, if that's the case, do you think that the bar has gotten much higher in terms of how weak the data has to be and how many points of data we have to get for the Fed to really embark in a rate-cutting cycle this year at all?
Yeah, the Fed's been burned a couple of times. It kept policy easy for way too long. That's pretty clear. Talked about the pivot late last year. That was too early. That's 0 for 2. Do you want to go 0 for 3, as my colleague Fred Stemp says? Probably not. So what that means is I think the Fed does need to wait. The bar probably has become pretty high. And also, lastly, on that point, Jay Powell wants that first move, whenever it is, to be a unanimous vote. He has nowhere near enough votes now to even think about going for one move, let alone a bunch. So the bar is quite high right now.
Mike, let's get to the bond market call. We had Daryl Cronk on the program just yesterday, and he talked about how flat the curve was outside of the very front end of the curve. Can we talk about some of those levels? The 3-year is basically where the 30-year is right now. The 5-year yield is where the 10-year is. If you're confronted with this situation this morning, if you're an investor, maybe you don't specialize in fixed income, you need to make a choice. Okay, I want some yield, some income. Got people screaming on Bloomberg surveillance about levels we haven't seen in a long, long time. Where do I want to buy across the curve? What are you advocating for, Mike, when you see that degree of flatness from 3 years and out?
Yeah, it's interesting. Right now, I'd say it's premature, Jonathan, to extend out the curve. People, when they want to extend, think about this. They'll say, look, I'm getting a tremendous rate right now in my money market, or just sitting in Fed funds at 5.33. Why should I take that extra risk? The reason I would do it is if I think the Fed is going to cut pretty soon, and I'm not going to get that lush 5.33 much longer. Well, pretty soon probably is not anytime soon. So for us, we'd recommend extending out a little bit, going out to, let's say, perhaps a 2-year, but not going all the way out to even a 5-year or a 10-year at this point. Too soon.
What does that mean for credit, Mike, if that's the call for the front end of the yield curve? What's your credit call?
I think that's one reason credit's held in well. So I'll step out of my lane a little bit and say, investor after investor that I've talked to. I was in Asia last week, talked to a ton of people, and they universally are tired of getting no carry, very little yield relative to their bogey. So any incremental yield to them is attractive. That's what I hear time and again in the U.S. as well. And I suspect that's why people have been so keen to buy credit. They say, yeah, spreads are tight on an historical basis, but relative to what I can get in terms of yield curve, which is negative, credit looks pretty good. So hence the strong bid for credit's persisting.
Yeah, the idea of all-in yields being something like 7 or 8% on average is sort of an anathema, given the fact that we saw 4 or 5% for so many years. Mike, when you zoom out, there's a real question here about what we're going back to. And the argument that you're laying out, that we could stay at these levels of rates for the foreseeable future, suggests that policy isn't necessarily sufficiently restrictive, that we still have inflation under the hood, and that, frankly, there is more strength and more inflation than most people had previously thought. Can you give us a sense of how that evolves over 2025, 2026?
Yeah, the thought from our econ team, and Sarah House does a terrific job on this, is that inflation will come down, but it's going to be a fairly bumpy process. And you've seen the U-turn over the last, call it, 6 months in inflation in the U.S. CPI is running amok. PCE is not behaving terribly well. She thinks the peak in PCE is pretty soon, and then it'll come down gradually. And remember, the Fed focuses on PCE, not CPI. There's a big difference. CPI is super high right now versus PCE for lots of reasons, but it's going to be a fairly slow process. The thing is that the market needs to see a couple of good prints on the data. And we keep telling people it's a market of catalysts, not levels. So you need to see probably 2 to 3 good inflation prints, whether PCE or CPI. And that probably, I would say, takes another 3 to 4 months minimum and could be into next year.
Mike, we just have the Senate overnight legislating this deal for $95 billion in basically defense to the U.S. allies. Biden will sign it today. What does that mean in terms of yields for Europe versus the United States?
Yeah, so this idea of defense spending going up is really interesting, and we suspect it's a global phenomenon. So if I were to take a look out a couple of years, I'd say which countries have to increase defense spending? Probably all the developed countries. Who's going to have the biggest delta? Most likely not the U.S. U.S. gets a lot of attention. Certainly the bill it's passing now is front and center. But if you think about the situation, let's say in Germany or in France, where you've got defense spending generously, maybe at 2% of GDP, where does that go? 3 plus, 4 perhaps in a couple of years? That's a ton of incremental supply in their markets on top of a lot of extra supply of treasuries. You put it all together, what you have is a lot of extra bond issuance coming to market from these developed issuers. And that to me means that real yields have to be higher over the next 3 to 4 years than they have been in the past. But it's a really topical point. It's key. Yes,
this is a really interesting call. I apologise for jumping in, but I've only got about a minute left on the clock. Peter Cheer of Academy Securities has said the same thing. Now, typically, as an investor confronted with heightened geopolitical tensions, you'd be buying core fixed income. But if you believe it results, if you believe the consequences, high defence spending, are you making the argument that maybe that trade's not going to work?
Yeah, I think the trade is really twofold. So let's say tensions pick up in the short term. Knee-jerk reaction is people buy treasuries, they buy boons, they buy the short end, the usual stuff. But then as they step back a little bit and say, what does this mean over the longer term? A lot more issuance, probably really going to impact longer yields to a fairly large degree. So it means you're going to see this secular steepening, there we go, can hardly get it out, in yield curves, and that's going to be a big shift. So near term, rates down, front end as well. Longer term, higher yields on the back end.
You finished and Lisa's smiling. Supply starts to matter again. Mike Schumacher of Wells Fargo. Mike, thank you. Appreciate it, Mike. Thank you very much. We've heard that point before from Peter Cheer. I think it's fascinating.
It is fascinating. The issue is then we ask people, well, how much of the deficit's being priced into markets right now? And they say, yeah, it's not that big of a deal. And you see that with every auction. So at what point will it start to matter? Because it is a valid point academically and intellectually. But the market has defied all academic and intellectual arguments for the bulk of the past couple of years.
The last 4 years, yeah. I would say, post-pandemic. Still trying to figure this out, aren't we? I know. Coming up in the next hour, we'll break things down with BlackRock's Kate Moore. We'll catch up with retired General Mastin Robson. Tiffany Wilding of PIMCO joining us to look ahead to the data this week and look ahead to the Fed next week as well. Mandeep Singh of Bloomberg Intelligence will be joining us too. That's all coming up very shortly in the third hour of Bloomberg Surveillance. Equity futures right now on the S&P 500 positive by 0.2%. Bond yields are higher by 4 basis points. 464 on a 10-year. The 2-year up by 3 basis points. 494 from New York City. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have 2 assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
When you look at the relative earnings growth, it's going to decelerate for that Mag 7. And it's going to be overtaken by the forgotten 493.
It's not so much about the earnings results, it's about the reaction of the stock to the earnings results.
When we listen to earnings calls, we're starting to see a normalization in consumer spending trends.
What you are hearing is consumer demand that's held up better than a lot of people expected.
We get 30% of earnings this week. We got to go. We got to get the engine humming here.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Earnings season has just started for Mag 7, live from New York City this morning. Good morning, good morning. Equity futures on the S&P 500 positive by 0.25%. Straight out of the gate, out first, we heard from Tesla. Out later, we'll hear from Meta. Into next week, you'll hear from the likes of Apple and Amazon. Before this week is out, you'll hear from the likes of Google and Microsoft. Bramo, what do you want to see from these big players over the next week?
What's the bigger surprise for shareholders? To quote Mike Wilson, the reaction to the response that you get from the earnings reports may be more interesting than the earnings reports themselves. Is the bar set too low, or is the bar set too high at a time where these had been outperforming and then saw a bit of a hiccup?
Yeah, to your point earlier in the program, I think Tesla a perfect example of that. Hammered going into earnings, down by more than 40% year to date. On the morning, take a sneak peek of this. We're up by 12% in the pre-market on Tesla, off the back of, I'm not even going to say it was off the back of the numbers. I think it was off the back of just a commitment to that potentially, and I say potentially because we really don't know, potentially the launch of a lower cost vehicle, because that's where this market wants this company to be.
August 8th, that's what Tesla's Elon Musk kept saying on the conference call yesterday when everyone was asking, well, tell us about either the robo-taxi or what about this $25,000 car that you're promising? And that seemed to be when shares really skyrocketed. Everyone was talking about, okay, they're finally getting back into plans for a cheaper Tesla model. And yet he said, we'll have more information on August 8th. And the question then remained, well, is he just obfuscating for a reason, trying to give the market a little bit of what he wants? But then Pierre Ferragu made a very good point. It's like an iPhone. You're not going to give too much away before you set to unveil it.
Channel that into later this today after the bell when we get Meta earnings. Those shares are up 40% this year. So they're up almost as much as Tesla is down. How different are the earnings going to have to be to generate the same kind of reaction? That's what I want to see.
Zero conviction on a ton of things. This from Kit Jukes this morning. A tangible lack of conviction in markets. You think? I think you agree, right?
It's so frustrating. I mean, everyone comes on and they come up with a thesis and it's sort of half-hearted and trying to figure out how they're going to edify it. This is a confusing moment, which is the reason why people are talking about the earnings and the specific companies. It's much more comfortable than macro, because good luck getting macro right and then even getting the market call, even if you do get it right.
Yeah, getting the second call right has been tremendously difficult for quite a long time. Equity futures on the S&P 500 positive by 0.2%. There is a lift in this equity market. In the bond market, yields shaping up as follows. We're higher by 3 or 4 basis points on the session to 463.76. The euro a little softer. German business confidence was better, not supporting this currency, still trapped in this range of 106 to 107 at 106.89 and softer by 1/10% on the day. Coming up this hour, we'll catch up with BlackRock's Kate Moore on why this earnings season is crucial for investor optimism. General Mastin Robeson of Academy Securities as the Senate passes Ukraine aid, and PIMCO's Tiffany Wilding on US GDP ahead of next week's Fed meeting. We begin with our top story. Stocks pushing higher, led by Tesla. BlackRock's Kate Moore saying this: after a healthy pullback in equities over the last few weeks, the pressure on earnings and constructive guidance is particularly high. The biggest right tail risk for 2024 is that earnings come in much stronger than current forecasts. Kate is with us around the table. Kate, good morning.
Good morning.
It's been too long. It's great to see you in person here in New York. Let's talk about that upside potential on the big tech names over the next week. How great is it?
So I think the big thing to watch here is not what happened in the first quarter. I mean, we want to see some monetization on AI. We want to see constructive guidance on AI. But I really think it's going to be the tone for management. You guys were talking about Tesla a moment ago, and I think this was the critical thing turning the stock price there, is that it sounds like there's a plan. And I think there's been a lot of good news priced into a lot of the big tech companies. But this is a chance to really kind of show me, what does the rest of 2024 look like? How are we thinking about AI spending? What does customer demand look like? And then we can go from there.
Are you saying we need a C-suite therapy session on earnings calls?
Yeah, we need to see a constructive, happy face from all of these leaders. By the way, a funny bit, we've talked about this before, but we always want to listen to CEOs and say they're kind of the strategists, they're the ones thinking big picture. But it's also really, really important to listen to the CFOs, who tend to get really down into the dirt. And so I'm going to be listening to both, for both the strategy as well as the hard data.
Will happy talk work for the likes of Meta or even Alphabet, given how much the shares have gained so far this year?
I think we've taken some pressure off of those stocks in recent weeks, as some prices have come down, and we've seen kind of growth in general as a factor fade a little bit since the end of the first quarter. That said, they really do need to deliver, I think. These are well-owned names. They're well-loved names. They're names that are expected to really lead the market, not just through 2024, but through the rest of this cycle. So I think it's possible for them to get people excited, but we recognize that they're well-held, well-owned going into reporting.
Moving outside of big tech, your idea here is a really fascinating one, that the biggest risk is upside risk, that we actually get better than expected earnings data, and that could fuel a rally among a lot of pessimism still out there. Yeah. Why do you think that's the biggest upside risk at a time where it seems like there's still a lot of bullish sentiment right now?
So I think it's about the mechanics of how we get to the bottom line that really matter here. And in this case, I want everyone to have some confidence in U.S. companies doing the right thing, continuing to manage their costs, continuing to manage their labor force, thinking really long and hard about where they're putting their dollars in each businesses so that they can really deliver on earnings. Even in an environment where revenue growth is just okay, and I think we've heard that from some of the companies that have reported so far, it's really the bottom line I want to see companies deliver on. And we saw, actually, since the earnings recession ended, that this focus on cost control and this focus on delivering earnings has been front and center.
This doesn't speak of some sort of screaming hot economy, though.
Yeah, I don't think we want a screaming hot economy for a variety of different reasons. We want a solid economy, we want solid demand, we want rates and to be stable, and we want certainty, or at least lack of uncertainty when it comes to policy. I think that's an environment that corporates are looking to kind of capitalize on and that they do well on. And one thing we're not mentioning here is the election year, and of course the uncertainty around the election outcome and what that might mean for policy is weighing on companies a little bit. So if we have stability in these other areas, in growth, in demand, and policy rates are relatively stable, I think that gives them some confidence to continue to do these cost cutting and really managing their margins.
How are CEOs thinking about the election? I imagine on these earnings calls they get asked about it, and they have to really walk a very fine line, be very careful.
Yeah, I mean, I think that they're being deliberately evasive because they don't really know what to expect. And we know that there's a huge amount of different policy outcomes for both administrations, depending on who wins in November, because a lot is going to depend on Congress. So they don't want to bank too much one way or another on support or on challenges. They're just trying to kind of manage over the next few quarters.
But given the fact that we do know who these two individuals are, they're basically two incumbents up against each other. Does that help executives plan for the future?
I think we understand big picture some of the main tenets of each of these or the policy programs. That said, it's really hard to say what the details are going to be, what the timing of any changes might be. And I'm going to go back to this Congress point again. There's a limitation to how much an executive can get done, a chief executive in this case, without support from Congress. So I'm going to be watching, frankly, the Senate and House races very closely going into the fall.
Which is the reason why a lot of people are looking for some sort of split in terms of Republican and Democrat on the different sides of the government. I am curious about what you said, which is at least stable rates.
Yeah.
Which raises this question, if the Fed holds rates at this level, is that fine? As long as there isn't any volatility, that's going to be enough to potentially fuel a pretty significant rally in equities.
I think stability and certainty are things that equity markets love, right? And when it comes to rates, would it be nice if we saw some rate cuts? Sure, but we also know that 80% of U.S. large cap debt is long-term fixed. We don't really have to worry about this in 2024 or even the beginning of 2025. What we do want to kind of, be able to incorporate is, expectations for the next couple quarters. And if we're constantly adjusting and it's, will the Fed be cutting or will they not? I think that holds back some decisions that corporate leaders need to make, which will be supportive for growth. So stability is better than any outcome, I would say.
Well, to Anne Marie's point, it's hard to talk about stability at a time where we can't really come up with any clear narrative. When we're talking about the potential for tariffs, and we're talking about geopolitical risk. I mean, how much does that sort of give you some pause in terms of the degree of bullishness and where you're looking to hedge just on the margins?
Well, I think the thing I'm watching in regards to that uncertainty, the geopolitical uncertainty, and perhaps the policy, the government policy uncertainty, is what happens to capital expenditure. And particularly if companies just go through with regular maintenance, necessary CapEx, and hold off on real expansionary CapEx until they get through the U.S. election. But of course, we know it's not just the U.S. election. There are elections all over the world this year. And frankly, U.S. companies are mostly, or many of the large cap ones, are geographically dispersed, right? So they have big businesses in many different regions. So policies in each of those regions will affect their decisions. So I'm kind of waiting to see, how do they talk about capital expenditure? Are they waiting to get more clarity on the political side, or do they see such a long-term secular tailwind to whatever this project is that they're willing to spend despite the uncertainty?
Are international companies better hedged or worse hedged right now, given the fact that they do face different political regimes and frankly, different economic realities?
Well, it's very, very challenging to manage a global multinational corporation. Regulations here, political change there, change in demand, consumer behavior. So I get all of that. I like the geographic diversity, though, of these multinationals. I think that's going to really lend strength to them through multiple parts of the business cycle and through all of these elections.
You like Japan. Can we finish on Japan?
We can.
Does the FX market matter? Sort of preoccupied with the prospect of breaking through 155, which we're about that far away from doing. Does that matter?
I mean, it matters, but I think there's more on the ground that we like about the Japanese market.
That's what we hear. Can you go through the details?
Yeah, I mean, I think that we're seeing a change in consumption. I think for the first time in a very long time, over 10 years, a real shift in how corporates are being forced to behave, which is much more shareholder friendly. Would I like to see more Japanese individual investors buy into the market? Absolutely. We don't want this just to be a market that's participated in by international investors. But I think both the macro side and some of the structural bits in the market are quite supportive. The currency could be supportive as well, but I don't want to base my thesis on that because, frankly, I don't have a great track record on FX trading.
Yeah, FX is difficult, but what I hear from you is this is not just some sort of short-term tactical trade. This is fundamental, much longer term.
We believe it's fundamental. And so we're buying really high-quality companies that benefit both from things like, you know, the macro demand, global demand, so this is where geographic diversity really helps, as well as companies that are going to kind of come up in the market as they make these big corporate changes.
Kate, this was awesome. Kate Moore of BlackRock. Dollar yen. I think we're just going to focus on it as it gets closer and closer to 155 as we speak. 154.97, the higher the session. Let's give you an update on stories elsewhere this morning. Some actual news. Your Bloomberg brief. Boeing shares trading higher in the pre-market. The company reporting earnings that beat Wall Street estimates. It also burned through $3.93 billion in cash in the first quarter, a less dramatic drain than analysts had expected, as the embattled plane maker continues to slow output to get a handle on its manufacturing issues. A second story, Tesla, shares surging in the pre-market, up by almost 12%. The EV maker is accelerating the launch of less expensive cars in an attempt to revive sagging demand, despite multiple price cuts. The news overshadowing a big shortfall in the company's first quarter earnings. Tesla reporting worse than expected revenue and profit. CEO Elon Musk saying he wants to start production of new, cheaper models this year, aiming for an early 2025 rollout. And finally, Secretary of State Antony Blinken in China, ahead of meetings with senior Communist Party officials. The trip starting in Shanghai before he heads to Beijing to round out the week. Blinken expected to discuss China's manufacturing overcapacity and trade with Russia supporting its war against Ukraine. We're reporting here at Bloomberg that a meeting with China's President Xi Jinping is a possibility. Now, Anne-Marie, I feel like these comments on China have been on repeat now for the best part of 2 weeks, and we've all been asking the same question. Show me the policy.
Well, there's two policies to look out for. One is going to be the tariffs, the China EVs that Secretary Janet Yellen went to great lengths to talk about when she was in China, but then also this idea of the U.S. administration very concerned about how Chinese banks, these secondary sanctions potentially we could see on Chinese banks that are helping Russia.
Look out for headlines on that visit for the next 24 hours or so. Up next on this program, Congress passing critical aid for Ukraine.
America sends a message to the entire world. We will not turn our back on you.
America stepped up, and the Senate held firm.
That story up next, live from New York. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We should have just sat here and stared at the chart together. Dollar yen. Let's share it as a chart together. Dollar yen breaking through 155. There it is. Magic. 154.91. I don't know if I should play this game, Bramo. We're coming to April. Let's go through it. We're threatening to break 152, and everyone's like, oh, do that. They're going to be busy. They're going to get into this market. That happened. 153. Nope. 154. Nope. 155. That happened a moment ago. We're at 154.90. They might, but I think it's curious, and we mentioned it a little bit earlier this morning. They've been much quieter, on the record at least, over the last 2 weeks than they were when dollar yen was much lower than where it is right now.
How much is this the market daring them? The verbal intervention not working time and time again, and basically saying, you want to come out, how much more credibility do you want to lose? Ultimately, this is the reason why Bank of America is saying that we could see 160 before you could start to get some real policy changes. What could they do other than maybe rate cuts?
Let's game this out. We can spend a little bit of time on it. I don't know what kind of level it would take for them to step in, but to Lisa's point, you lost credibility by using verbal intervention when we were south of 152. We were now north of 155 just months ago. You come out and act, and it continues to weaken. You lose even more credibility. You're fighting fundamentals here. They talk about disorderly moves and excess volatility. Very hard to describe what we've seen in dollar yen so far year today as excess moves and disorderly.
It is completely logical if you have the rate differential that you currently experience between the U.S. and Japan, which gives them two levers. They can either see the U.S. economy weaken and take that advantage to try to take some strength back for the yen, or they could raise rates.
We'll sit here and we'll wait. Not literally, but, you know,
kind of.
We'll be monitoring it. 154.93. Under surveillance this morning, Congress passing critical aid for Ukraine.
After more than 6 months of hard work and many twists and turns in the road, America sends a message to the entire world. We will not turn our back on you.
And as loud voices here at home insisted on abandoning the responsibilities of leadership, America stepped up and the Senate held firm.
Here's the latest. President Biden is set to sign a long-delayed $95 billion aid package into law, providing funds to Israel, Taiwan, and Ukraine. The legislation clearing the way for immediate arms shipments to Kyiv. General Mastin Robson, Academy Securities Advisory Board member, joins us now for more. General, thank you for giving us your time this morning, sir. Let's talk about that number. How far does $95 billion go in today's warfare? What difference does that make?
It makes a huge difference, but it doesn't go far enough to win a war. So it can certainly be a major movement to their ability to stop some of the aggressive activity Russia's been doing and hitting the homeland. But they still have shortages in air defense and in missile defense that they're going to have to tighten up in order to really be effective. The real key is, no matter how effective they are at stymieing Russia's aggressive activity, can they at the right point position themselves for a counteroffensive, which is the only way they can really change the dynamics of the war long term?
How quickly can the United States get their ammunition out of these stockpiles to the Ukrainians on the ground?
Yeah, that's a great question. It's my understanding that the transportation skids have been greased and that we're going to be able to accelerate the movement of the ammunition and equipment that's been promised. But your guess is as good as mine. We've got so many, as you know, disruptions in the supply chain right now that we're going to have to move through, and much of this is going to have to go by shipping, which will make it difficult. So your guess is as good as mine as whether or not we'll be able to circumvent those roadblocks that we've been dealing with for the last really 6-8 months.
General, you said it's enough to support Ukraine, but not enough to win. What would Ukraine need to win?
That's a great question. I think really to win, they're going to need more of an offensive strike. They're going to be more, what would include jets. It would include more long-range attack mechanisms. But what they're really short of right now is people. The ammunition and the equipment will be key, but they're running short on people. And if they can't backfill that, if they continue to just grind against Russia and in essence lose their manpower and don't have the ability to backfill that with not just people but with trained people, then it's going to be tough. Keep in mind that it's always easier to be the defense than the offense. This is a 3-1 ratio is what we historically state. So they will be able to hold out longer in the defense with less people than go on the offense. But they can't win without either a negotiated settlement or going on an offensive that, in essence, facilitates making Russia's advances untenable to cause them to draw back. Obviously, what the best outcome would be a negotiated settlement, but it's just hard to see that right now that doesn't trade territory for peace.
So how do you see this ending, General, at a time where the appetite politically to give more aid to Ukraine is definitely waning, and there's a question of how long they could just sustain this assault time and time again?
And there is no answer to that. There's no doubt that one aid package is not going to be sufficient. The one aid package gives them another maybe 6 months to be able to dig their heels in. A lot depends on how aggressive Russia is in a counteroffensive this summer. If they can really become aggressive, but keep in mind a complex obstacle belt that Russia has put up works as much to the disadvantage of their pivoting to the offense aggressively and with speed as it does to prevent Ukraine to pivot to the offense. So Russia is not going to be able to move quickly. It's going to be a slow grind, which certainly works to the advantage of Ukraine time-wise, but it doesn't give them the ability to win. It will take more aid from Europe. It'll take more aid from the United States, late summer, early fall, to take them to a place that really doesn't give them a chance to win, but maybe brings Russia to the point where Russia is willing to do a negotiated settlement. But you know as well as I do that Russia doesn't show any signs right now of weakening on their willingness to give up the territory that they've gained or to give up on their hope that this piece of terrain is really part of Russia and they by rights should be able to claim it.
If this is what happens, that essentially, eventually there is some agreement after Russia has taken some of Ukrainian territory, how at risk is the rest of Eastern Europe, as some people are arguing, to a Russian invasion?
No idea. I mean, I would like to say that historically speaking, Russia has never legitimately invaded Europe. They have certainly gone into the states that they're in now when they formed the Soviet Union. But from a Russian standpoint, Europe has invaded Russia twice. They've never invaded Europe. It's hard to predict Putin. I mean, Putin has certainly an appetite for grandeur. And that's dangerous when you have a dictator who has both capacity and capability and an appetite. Will he be satisfied with just a piece of Ukraine? Will the negotiated settlement give what's left of Ukraine a favored status or even a fast track into NATO? Those would obviously be significant movements in regard to if Russia does more, then does this draw NATO into a conflict? But it's almost impossible to predict what's going to happen. We haven't been able to predict the last 2 years of what was going to happen. It's been so fluid.
Yeah.
There's so many different political avenues here in Europe and in the United States and in Russia that impact all that decision making.
General, this was a clinic. Let's do it again soon. General Maston Robson there of Academy Securities. MH, what he said there I think is really important. Either you come up with a heck of a lot more money than we came up with overnight, and $95 billion is a lot of money, or you're going towards a negotiated peace settlement. The latter is hardly discussed. I find it really interesting. You speak to the generals, and this is what they tell you. But when you speak to the politicians, they won't even entertain the latter.
Not on the record and not in public, because that would basically implying that Ukraine cannot win this war, and that would be giving Zelensky the leg down that he doesn't need. He really needs the support right now. What's the point of sending those weapons if they don't think he's going to win?
Coming up next on this program, we'll catch up with PIMCO's Tiffany Wilding, reacting to durable goods data, looking ahead to GDP and PCE later on this week. Dollar yen, hello 155. That's next.
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I'm McKee dropping by the studio to break down some economic data. That data out in about 20 seconds' time. Let's whip through the price action for you. Starting with the S&P, futures positive 1/3 of 1%. The Nasdaq up a punchy 3/4 of 1%. In the bond market, yields drifting higher through much of this morning. On a 10-year right now, up 3 basis points, 463. On twos, just about unchanged, 493.73. And in the FX market, this one not a snooze. Dollar yen breaking through 155. We're talking about levels we haven't seen in more than 30 years. 155, a sort of round number roulette on dollar yen through the month so far. 152, 3, 4, 5, and we're all waiting for the same thing. Are they going to intervene? We'll see. Let's get some economic data. Mike McKee, what have you got?
Well, we got durable goods out this morning, and the numbers are better than anticipated. 2.6% gain for overall durable goods. That's after 1.3% the month before. In terms of ex-transportation, up just 0.2. There's a big Boeing effect in there because Boeing sold 113 airplanes in March, took orders for, and only 15 in February. So a big change we know coming from the Boeing orders department. Capital goods orders, non-defense, ex-air. This is the part that feeds into GDP, up 0.2. After a downwardly revised 0.4 gain last month, and shipments for March up 0.2 after a 0.6 decline the month before. That's a bit of good news for the economy, but the thing overall that has been bothering some economists is that we have seen capital goods orders running behind shipments for the last year, and that suggests that maybe we are going to see a decline in overall business spending at some point. Last time we got GDP, and we get GDP tomorrow for the first quarter, but for the fourth quarter, it was the second month in a row that equipment spending was down. So that's why durable goods matter, even though they're tremendously volatile. They give us a picture of maybe what's coming.
So this data, Mike, preliminary read on the month of March, so that wraps up Q1. Based on what we understand about the first quarter, have we got a decent read on what we're going to see tomorrow morning?
Well, you got somewhere in a range. The Bloomberg consensus forecast of economists that we've surveyed is 2.5%, which is still stronger than the 1.8 to 2% that the Fed thinks is the sort of neutral growth rate. And the Atlanta Fed GDP, now they'll probably incorporate some numbers from durable goods in there, is 2.9%. So we could see a stronger, the lean is to a stronger growth number tomorrow. In any case, it's kind of hard to see how the economy could get a whole lot better at this point, and it's hard to see why the Fed might, well, we'll know Friday when we get the PCE inflation numbers, why they might want to be cutting rates now. They can wait.
Well, this is what Mike Schumacher of Wells Fargo is saying. He thinks the bar has actually gotten higher with respect to cutting rates just simply because of how hot the data has been or just how strong the U.S. economy seems to be. Do you have a sense, based on some of the rhetoric we heard, not this week because it is the quiet period, but in previous weeks, about how much they have kind of shifted the sense of how many weak prints they need before they can have the conviction to cut?
Well, I think the weak prints would be a totally different story from an inflation print data that they're looking at. Weak prints, they would need a couple of months at least of rising unemployment, significantly rising unemployment. We go back to the Somme rule. Do we see it go shooting up? For inflation, they're going to want 2 or 3 months now because we've had 3 months of inflation going the wrong way. So I think right now, the earliest you could possibly see, unless there's some big surprise in the next 2 days, is July. But the September-November time range for the Fed is probably the most realistic if we get the economy, as they put it, developing as expected.
Mike Schumacher was also talking about the point that Powell will want serious consensus across the board before he goes for that first cut. Do you see that possible, given the rhetoric we've heard from some of these officials?
Oh, I think it's possible. I think what you've got now is sort of developing consensus that they're not going to be cutting anytime soon. So if they push it back, that just by nature means fewer this year and probably means fewer for 2025 as well. The economy seems stronger than the level of rates implied by the last dot plot would give you. So we may not see them cut as fast or as much. But Powell generally works by consensus, and he probably can get consensus on this. I don't see anybody really lodging any kind of dissent. Most of the bank presidents are on the same side. A couple of the governors may be looking to disagree, but by tradition, lately, last 10 years, 15 years, they don't dissent.
They hate it.
Yeah.
Lisa mentioned it's the quiet period. We've got the Fed decision next week. Mike, how big is that? Based on the amount of communication we've had over the last week, could we get anything new next Wednesday from the FOMC?
Well, people want to see something new. I mean, markets want to trade on something, so they're going to be looking at Jay Powell. Nobody's expecting him to do anything on policy, and there's no new economic projections. There's no new dot plot this time. So they're going to be looking at Powell's news conference, and everybody went back and looked at December and said, okay, he pivoted to a dovish stance. I reread the transcript, and I'm not sure I see as much of that.
Well, now
but people give that
the
credit.
pivot to the pivot.
Yeah, so now there's a thinking that, well, maybe they pivot the other way because markets have priced out too many cuts or something. I'm not sure that he's going to see it that way.
That's a U-turn.
Collective sigh around the table. It's like staring at the sun. Michael, thank you. Mike McKee. It's like that Laurie Calvasina line over at RBC. It's just like staring at the sun. That light's really bright too. Equity futures on the S&P. Positive by a third of 1%. Don't stare at the sun, children. In the bond market, we look like this. Isn't that what the kids say? You know,
you
the
can do it
parents
with
say
the
to the kids
glasses.
when we had the eclipse the other week. Don't stare at the sun.
You can
I still
with the
love, every
glasses.
time I say that, I think of the former president staring at the sun on the balcony of the White House.
Yeah, I saw people using two things of sunglasses. I wanted to go over them and say, no, please,
No.
come on. No.
Still got those spots in my eyes now. Anyway, up 5 basis points on a 10-year, 465. On a 2-year, up a single basis point, 495. All the attention on dollar yen. Briefly breaking 155 and back down to about 154.98. Bramo, dollar yen. We've gone through so many round numbers this month. Why is this one any more important than the last one?
Just each time you're sort of boiling the frog, right? You're sort of amping up the pressure and raising the question of, okay, if they're not going to intervene here, they're not even going to jawbone it, well, then what's next? What level do they start to worry about? Since we haven't heard from them, I think that's really the question. At what point is that taken off the table, and how far can traders push this?
Do you think there are certain times of the day, in certain periods, maybe in certain regions where there's less liquidity, that they'd want to step out and step into this market, that maybe now's not the time? Maybe a little bit later tonight.
Are you suggesting that Asian hours of trading, when it tends to be thinner liquidity,
when liquidity is low
time?
and you want more bang for your buck? Mike McKee dropped by the studio. Can we just 30 seconds? Mike, go through those numbers. Go through those numbers.
The Bank for International Settlements tracks the amount of currency traded. Do a survey every 3 years. 2022, last time they did it. $7.5 trillion traded every day in the Forex markets. And in 2022, the last time Japan intervened, they spent $60 billion US. So moving the markets is very difficult. It's a psychological thing, and usually you're looking for a turning point. You're looking for a bad economic number or something like that that moves the currency, and you pile on and you push a market that's already going in that direction. But right now, it doesn't look like the market's going in that direction.
No, 155, 154.99. On the data this morning, the data tomorrow, and going into the Fed next week, I'm pleased to say that with us is Tiffany Wilding of PIMCO. Tiffany, wonderful to catch up with you again. Just had a bit of economic data this morning, going into GDP tomorrow. What are you expecting from the first quarter, and how do you think everything we've seen in the first quarter of this year will shape the conversation next week?
Yeah, so we're looking for a pretty strong report. I think the Bloomberg consensus, as you mentioned, is 2.5, but our lean as well is on the higher side of that. And I think the more important thing that we'll be focused on, is just the core measure of GDP, final domestic demand growth, which economists call it. That's going to be incredibly strong. That strips out the volatile trade and inventories categories, and that looks like that's going to be above 3. And the thing that we've been really highlighting and focusing in is that will be the third quarter in a row that we've gotten core GDP growth of above 3, and that's something that we haven't seen since 2014, absent the pandemic-related rebound. So all of this is to say is that GDP in the United States is incredibly strong, and that strength has continued after 2023. We've seen strong momentum going into 2024. All of that suggests that inflationary pressures in the economy, we're running at a hot economy here, and it's not really consistent with inflationary pressures further moderating.
Do you think that will shape the language in the statement next Wednesday when we open that up at 2 p.m. Eastern time? Is that going to look any different?
Yeah, I think you could see some changes to the statement, but I think what markets will be more focused on is what Powell says in the press conference. And his, in the past at least, Powell has made reference to the SEP projections, prior SEP projections at a non-SEP meeting, and given us some hints on how he thinks they could change. And we think that's potentially what he could do now, set the stage for more revisions to the SEP that we're going to get in June, say that the inflation forecasts are likely going to have to be revised up, and then as a result of that, sort of hint at the fact that you could take out maybe 1 or even 2 cuts in the forecast for 2024.
Tiffany, I hate to do this. I feel kind of a little bit dirty doing this, but is this a pivot to the pivot that we got in December?
Well, it does seem like in some sense the pivot party from December is over, and I think that's as a result of the inflation prints that we've seen, and again, just the economy is just incredibly strong. We have argued, that, the so-called last mile on the inflation, in the inflation race is going to be the toughest, and that's just because we have a strong economy, labor markets are tight, and that just is likely to result in inflation hanging above their target. And really the question is, are they okay with that? And it seems like, there is some threshold, maybe we think it's 3%, where they won't be okay with that. But, above 3, it's okay. But again, it's a bit, monetary policy is a bit of an art and a science here. So, I think the art is that, they don't really need to be cutting. They shouldn't be in a rush. And so really it's up to them to choose when they start to do it.
You said the pivot party is over. And when people were talking about the pivot party, it was including a real rally in risk assets. So I wonder, okay, pivot party is over. The earnings party just getting started. Is this basically an economy that can handle where we're at right now? And that's basically what we're hearing from a lot of people around this table.
Yeah, it's certainly not only obviously the equity market, we look at equity risk premiums, and even though you've seen some weakness in the equity market, the additional yield over treasuries, earnings yield that you get over treasuries is still looking okay. We're still looking rather narrow in the equity market. So from a valuation perspective, equities, still look somewhat rich here. But nevertheless, I would just say if we look at the GDP data, the data that I focus on more, we're seeing a reacceleration in cyclical sectors of the economy. That is residential investment, even in CapEx and things like that. Corporate profits, NIPA corporate profits have reaccelerated as well. So, and this is at these high level of interest rates. So it does seem like the peak effects of the monetary policy drags, they are increasingly behind us. And that suggests that, yeah, maybe the economy can withstand rates at these higher levels.
Which raises this question, how much do financial conditions, frankly, how rich stocks are, how well bid credit markets are, how much does that influence how long inflation can be persistently above the Fed's target?
Yeah, I think overall, the Federal Reserve monetary policy works through not only the policy rate, but a broader context of financial conditions. And the point that we've been making lately is that you need financial conditions to tighten here in order to cool the economy down. And the question is, how does the Fed engineer that? Now, partly they can engineer that through just staying on hold. The bond market is still pricing in cuts. So the longer they push that out, stay on hold, that should sort of mechanically tighten financial financial conditions. And I think that's what the Fed will try to do, and just see if that's enough. And maybe rates on hold longer will get them that financial conditions tightening that they need in order to cool things down a bit here. But of course, if not, then they'll have to find other ways to try to tighten a little bit more.
I know we're all focused on inflation this week, but I wanted to ask you about the jobs market, because in your note, you talk about elevated immigration, boosting both supply and demand. What happens if we still don't have those same levels of immigration, whether or not it's executive order that Henrietta Trace says potentially coming out of the Biden administration, or a whole new paradigm next year if we get an entire different administration?
Yeah, so that will result in growth slowing for sure. Because immigration boosts both supply and demand, the effects on inflation are more nuanced, we would argue, and they're less clear. So, what we could see is if you have immigration that is falling, we've had a lot of asylum seekers cross our borders over the last couple of years. We estimate that that's contributed around 50 basis points to 100 basis points to GDP growth. So if you don't get that, we will absolutely see growth slowing. But in terms of the inflationary effects, that's certainly less clear. Now there are folks that are in the economy now. They have workers' permits. They're waiting for their asylum hearings. I guess if there's policies to try to, make them wait in Mexico or other places like that, that growth drag will be even more. But we'll just have to see how that plays out.
Tiffany, as we were talking about U.S. strength, how pronounced it is, how much longer it could last. I was just thinking of your cyclical outlook that you helped lead, and reading through that note, the amount of divergence that we can expect. What about everybody else? What is the growth backdrop going to look like, the U.S. versus the rest of the world?
Yeah, well, ultimately, we still think that, there is some durability in this U.S. exceptionalism story, that started in 2023. And really the factors that we believe contributed to that was just the fact that the U.S. government fiscal stimulus during the pandemic was much larger than it was in other developed markets. We've also seen, what I call less mean reversion in our federal government fiscal deficit since then. They've been kind of structurally hanging around 6 to 7%. Everybody else has managed to get more fiscal retrenchment. The other thing for the United States is that we've seen less pass-through of monetary policy via the interest rates that people actually pay. We have a large stock of mortgages that are low duration, low interest paying, long duration, low interest paying. That's just not, the consumer is not feeling really the effects of higher mortgage rates in the United States. They are elsewhere. So we think these things can continue, at least through our cyclical horizon. I think structurally the U.S. economy is also just delivering better productivity growth than some of our peers. And I think that can certainly continue, versus Europe, for example, where they've had, a pretty big energy shock that's made them somewhat less competitive. Obviously, weakness in China has also had a bigger impact on Europe. But all of these things in our minds can contribute to this U.S. exceptionalism story. And eventually, that's also going to create divergence in monetary policy, we think.
Tiffany, enjoyed this and enjoyed the note as well. Tiffany Wilding there of PIMCO. Just getting an important headline crossing the Bloomberg. Very light on detail, but want to bring it to you. MH, what do you see?
Israel striking 40 Hezbollah sites in South Lebanon. Remember, of course, we've been waiting if potentially there's going to be more skirmishes or, strikes between Iran and Israel. This looks like Israel is striking Hezbollah, obviously a proxy of Iran. But then also, Jonathan, I'm seeing as well an alert from the AFP saying Lebanese Hezbollah has launched, quote, dozens of rockets at Israel after civilian deaths. So it seems like this is going both ways.
A developing story. When we get more detail, we'll bring it to you. That's the latest so far. Allow me to bring you some detail on stories elsewhere. Let's get to your Bloomberg brief. Your first story. Talks to resolve a standoff between pro-Palestinian demonstrators and Columbia University officials are extended after a deadline expired at midnight. The Columbia Spectator reporting that the two-day extension came after significant progress in discussions. Student representatives agreeing to 4 commitments, including cutting down on tents in their protest encampment. House Speaker Mike Johnson said to meet with Jewish students at the university later on today. The clock is running for TikTok. President Biden plans to sign an extensive foreign aid bill today, which includes a provision demanding the platform's parent company divest or face a ban. ByteDance now facing a 270-day countdown. The Beijing-based company has vowed to do all it can to stop the measure. The company says the legislation infringes on the free speech rights of its 170 million U.S. users. And finally, a new Department of Transportation rule says airlines must provide automatic refunds to customers for cancelled flights. The DOT's new regulations saying passengers will be owed money back for any so-called significant changes to their travel plans, including delays of over 3 hours on domestic flights, an increase in the number of connections, and a whole lot more. Secretary Pete Buttigieg saying the following: passengers deserve to get their money back when an airline owes them without headaches or haggling. I think we can all agree on that. Up next on the program, AI in the spotlight.
Microsoft is a very big report this week. This has always been known as the cloud bellwether. It is now the AI bellwether. If we continue to see that ramping up, I think the market will be very excited.
A conversation up next, live from New York. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg.
"40 minutes away from the opening bell. 2 days of gains on the S&P. Solid day of gains yesterday. The biggest one-day gain we've seen going back to February. Equity futures up 0.1%. Yields drifting higher once more, up 5 basis points, 464.58. The euro weaker, dollar stronger, including against the yen. Briefly, 155. Done that a few times already in the last 20 minutes or so. 154.98 this morning. Under surveillance, AI in the spotlight.
Microsoft is a very big report this week. This has always been known as the cloud bellwether. It is now the AI bellwether. This is where the real growth is happening if you look at certain pockets. Outside of that, we're seeing a lot of deceleration if you look very closely. So we want to see Microsoft continue to do what it did before. We're talking on about $75 billion segment. If we continue to see that ramping up, I think the market will be very excited.
Here's the latest. Mag 7 earnings in full swing with Meta reporting after the closing bout today. Microsoft, Alphabet, they're due to report tomorrow. Microsoft in focus for many investors, with the company leading the way in the deployment of artificial intelligence. Mandeep Singh of Bloomberg Intelligence joins us now. Mandeep, good to see you. Let's talk about the numbers we get later before we talk about Microsoft. That's the big one I know for you. Meta, what are you expecting?
Well, Meta, I think what they have done is, one, the year of efficiency was a winning move. And, you know, you're seeing that EPS estimates go up by almost 40% for 2024 as a result of that. And they've actually made that pivot to AI, which everyone wanted them to do, you know, in terms of shifting from metaverse to AI. And that also looks to be a very smart move, because now they have a large language model, their own model, where they can build an ecosystem. I do think they should move away from hardware. They'll never be successful in hardware, but they still are spending on reality.
Never's a strong word.
Well, simply because they have spent, you know, almost $50 billion trying to develop, VR, AR glasses. And look, I mean, it is a niche category, but when you have got Apple stepping into it, and clearly they can't make a dent in terms of, driving revenue out of that, that tells you something. And it's just so hard for Meta to create an ecosystem as a hardware maker. So I have my reservations in terms of how that strategy may play out. But look, as long as they keep growing 20% plus, nobody minds them losing $4 billion a quarter on Reality Labs.
I love this. I love are they going to rename from Meta to AI at this point to try to get a better branding at this point? I'm curious about how low the bar really is. And we got that sense from Tesla. Are they setting the tone for earnings, even for the likes of Meta, where shares are up 40% year to date?
Yeah, so they have shown that they can grow over 20%. The one caveat I would flag here is they have exposure to Chinese advertisers. So they have no China revenue exposure, but Chinese advertisers like Temu, Shine, and to an extent TikTok as well, they advertise on Meta's platforms. And that revenue is close to 10% of their overall revenue. It was 5% of growth last quarter. So if things go south in terms of advertisers pulling back, and look, this is an auction mechanism, so it's not as if that revenue will go to zero. There are still advertisers who would bid for those ad slots, but that ad pricing would take a dent if, the Chinese advertisers pull back.
I'm still shocked that you don't think Meta has a chance in these wearables, because the Ray-Ban glasses are a much better price point, and they're actually kind of cool.
But you know how much they're subsidizing? How much is Meta subsidizing the cost of that Ray-Ban glasses? The reason why they're so cheap is because Meta is subsidizing the hardware.
Wow.
That's the dent in the $4 billion every single quarter. That's how much money they're spending.
They have no markers on what they spend those $4 billion on. And when they were growing, low single digit, everyone was asking, okay, what's going on? Now nobody cares because they're growing over 20%.
Quick final word, Microsoft, going into tomorrow. Is that the big one for you, and why?
It is huge. It's, I think, the company that's able to monetize AI, both on the cloud side and on the product side. And look, I think what they've done is developed an ecosystem where they can actually deploy AI and, have other people rally around it. So think of, the operating system, the iOS and the Android. Microsoft is trying to develop that in AI. It's still early days, but if they're able to do that, they'll be hugely successful.
I imagine we'll be catching up with you tomorrow morning and looking forward to it. Mandeep Singh there of Bloomberg Intelligence as big tech earnings get underway. Yesterday we heard from Tesla. We're going to hear from Meta a little bit later. Tomorrow we'll hear from Alphabet and Microsoft. Then on to next week, Amazon, Apple. You get the picture. You're all familiar with the calendar. Here's tomorrow morning, the lineup for you. Chris Harvey of Wells Fargo, Greg Peters of PGIM. We'll speak to Bob Doll of Crossmark, and we'll catch up with a Stifel CFO, Ronald Krzyzewski. Looking forward to all of that. We'll break down US GDP, have a chit-chat about jobless claims, and push ahead to a Federal Reserve decision about a week away. Going into the cash open, 34 minutes away. Equity futures just about holding on to positive territory. We're positive by 0.1%. Coming off the back of 2 days of gains on the S&P 500 and the biggest one-day pop going back about 2 months. More supply coming a little bit later. Bramo's working the late shift this afternoon.
Oh, yeah.
Watching that 5-year auction.
It's going to be thrilling.
Yields up 5 basis points. Your 10-year, 4.65. Live from New York City. This was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now. What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From New York City for our viewers worldwide, I'm Menace Granny. So these markets have turned around. Everybody loves a turnaround story, and that's what you get in Tesla. The stock up over 10%. Do you believe in Elon Musk? We'll count you down to the open as the Nasdaq is bid by 0.5%. Good morning. Futures move higher as the earnings parade marches on. Tesla and Musk deliver, providing a big boost to big tech. And strong demand for treasuries sets the stage for another record sale. We begin with the big issue. We're knee-deep in earnings season. Is it coming to the rescue?
We want to see some monetization on AI. We want to see constructive guidance on AI. But I really think it's going to be the tone for management. There's been a lot of good news priced into a lot of the big tech companies, but this is a chance to really kind of show me what does the rest of 2024 look like.
Show and tell time for big tech and AI. Alex Semenova joins me now with the earnings scorecard thus far. Alex.
Good morning, Manus. The stakes were incredibly high heading into the earnings season, and so far, corporate America is delivering. 180 companies reporting results this week, and a really strong readout this morning from some names. You have AT&T up as much as 4% in pre-market trading after beating analyst estimates on profit in the first quarter. They also added more wireless phone subscribers than expected. Boeing was up as much as 4% after reporting revenue for the first quarter that beat the average analyst estimates, and Texas Instruments is poised for its biggest gain in 4 years after the company's revenue forecast indicated a slump in demand may be easing. So a lot of positive results here across the board, but of course the burden is on big tech to deliver. The so-called Magnificent Seven stocks are expected to report 39% earnings growth from last year this quarter, very much in the driver's seat here. All eyes will be on Meta today after the bell, and IBM is also set to report results today after the close. Microsoft, Alphabet, Intel, and Snap are on deck for tomorrow. And we have to talk about Tesla, Manus. A big jump here in pre-market trading. The stock was up as much as 12% this morning. It was a better than feared situation here after a really challenging run for the company. Tesla said it's accelerating the launch of its less expensive cars in a bid to revive cooling demand, Manus.
Yeah, well, it's either believe in me, believe in, autonomous driving, don't bother being a stockholder. Alex, thank you very much. We'll dig into that in just a moment. Alex Semenova. Let's continue the conversation. My guests this morning are Kim Forrest and of Boca Capital and Invesco's Rob Waldner. Good to have you both with me. So here we are. We've got a show me the money moment in equities in as far as AI is concerned. Kim, let's just start with the rip off the Band-Aid moment in Tesla. It came through last night and it was a very clear message. Either believe in my mission, and be a shareholder, believe in my dream, but my numbers simply don't stack up to support my dream?
Well, that is the way of Tesla. And it's been hard to short that stock, I think, just because of the leader. He reminds me a lot of Steve Jobs with the, I can't remember what they used to call it, like truth suspension field around him, that he would tell you things that were like hard to believe. And then as an investor, you'd go, yeah, I'm in. And I think that's what's happening here. Although, to be fair, you know, some of their objectives are reachable with the lower end cars. And we'll see about autonomous driving. I've got my doubts about 100% autonomous all the time.
We'll only have evangelism here. We'll have no heresy on that front. Rob, good morning to you. If the equity market and Mag 7 are having a truth and reconciliation moment in terms of earnings, to the bond market, which is the auctions are grand, rock up. I get nearly 5% for short duration money. I'd say maybe even Kim might take a little bit of bond exposure into the portfolio on a bad day. But here we are. We've got auctions aplenty. The bond market is, it would seem to me, reconciled with one cut, no cuts.
Yeah, I think if you're looking what's really driving the market right now, there's two big factors here. One is this geopolitical risk that we've had bubbling around in the background, which looks like it's easing out a little bit. But I think from a macro perspective, even more important, we're kind of fully pricing this inflation stays higher for longer kind of scenario. So if you think through all the tail end last part of last year, we got very good inflation numbers, and the last several inflation numbers that we've gotten this year have been a little bit higher than expected. And I think the market's really taken on that fear that inflation is going to maybe reaccelerate, stay high too long. And in our view, that fear is probably misplaced. So what you have here is overall higher level yields in response to that fear. But the actual fact pattern, we believe, will come out different than that narrative. It will come out with lower inflation. And, you know, a key point will be on Friday, we get the PCE data, price data, which the Fed looks at. And if it comes in as expected, it will be below 3% year on year, both headline and core. And that will probably help us in the markets to release some of that fear. So as you said, you know, we don't have very much price in terms of Fed cuts. If inflation really is coming down, we could move to price in more cuts.
Just briefly before I bring in Mike McKee to set the table on the eco data for the week, would you say, Rob, that higher for long, we are accepting higher for longer maybe for 2024, but there's still a residual belief that you will get cuts going into 2025. At Bank of America with me yesterday saying, how do you price 2 years? If you have higher for longer for 2 years, it's 540. So what is price? I mean, it's higher for longer for 2024, but still clawing at cuts 25?
Well, what's priced right now is some cuts in 2024 and some in 2025. I think the bottom line is, Manus, that nominal GDP is slowing. So this is what the market is understanding. Nominal GDP is slowing because inflation and growth are both coming down a bit. And so if nominal GDP is slowing, the overall level rates have to slow and the Fed, or come down, excuse me. And the Fed has told us that that is the framework they're using to think about interest rates is, you know, that as inflation comes down, they should be bringing down rates. So the trend is clearly in place 24, 25 for rates to come down at the Fed.
Okay, well, look, there's plenty of economic data to chew on this week. And as you said, the crescendo will be the PCE on Friday. Mike McKee is with me to set that table between now and then. What's in the banquet?
Well, we are going to be seeing GDP tomorrow for the first quarter, which should have political implications and may have implications for the Fed as well. Durable goods orders, one of the final pieces of GDP out this morning, coming in up in March by a healthy amount. However, most of that was Boeing orders, 113 planes ordered in March compared with only 15 in February. So when you take out transportation, up just 0.2%. Capital goods, non-defense, ex-aircraft up 0.2%. 0.2%. That's the one that feeds into GDP. Actually, it's the shipments numbers, and also those were up 0.2%. So probably no change in GDP from durable goods. However, I do want to show you a chart that worries some economists about going forward, and that is that durable goods orders are running behind shipments and have been for about the past year. So as companies catch up on shipments, do we see business investment continue to rise? As you can see there on the left-hand side, it looks like business orders for capital goods have sort of flattened out, which is not overall good news. You mentioned the PCE numbers on Friday. GDP tomorrow, we're expecting 2.5%. PCE, 0.3 for both the core and the headline in terms of the month over month. This is going to be like CPI, where core goes down and headline goes up on a year-over-year basis. Income and spending expected to be strong, so the consumer side seems to be doing okay. We get those numbers Thursday and Friday. And then next week, a lot of people want to talk about what Jay Powell's going to say about all this. There's a feeling that Powell pivoted too early in December. This is in the markets. And financial conditions eased, and now things have changed. But really, when you look at when he spoke in December with what he said last week, which is a little more hawkish, financial conditions didn't change all that much. They had been getting looser, and they're just a tiny bit tighter now. It doesn't look like the market has totally responded to Powell, but he's about all you got next week since there's no new dot plot. So there'll be a lot of focus on what he has to say.
Mike, it's the way you said. He's all that we've got. So let's see whether loose lips sinks ships in the bond market again. Mike, thank you very much, Mike McKee. So we also heard from J.P. Morgan, the CEO there, Jamie Dimon. He weighed in on the consumer.
Even when we go to recession, the consumer's in good shape. But that doesn't mean you can fight off the effects of stagflation or something like that if it gets much worse. And so, you know, I worry that it looks more like the 70s than we've seen before. If you go back to the 70s, deficits were half what they are today. The debt to GDP was 35%, not 100%. And so part of the reason I think we've had this strong growth is the fiscal spending.
Something for everybody from J.P. Morgan, the boss there, Jamie Dimon, Kim Forrest on the equity side, Rob Waldner on the bond side. Kim, to you, first of all, even if we do have a recession, and the jury is very much out on that, I hear very little consensus around a material slowdown. The consumer is in good shape, and he believes in the consumer. To that extent, how do you expose to the consumer at the moment? Is there any restraint? You talk about pricing power on the corporate side, but what's our tolerance like to take more price rises?
I'm sorry, could you say that again? What's our tolerance to?
What's our tolerance? I mean, from the corporate side, the corporates have been able to raise prices. We have absorbed those as consumers thus far, but are we at some kind of break point in terms of our tolerance for higher prices? Are we as strong as Jamie Dimon believes that we are in consumers, and how much exposure to the consumer do you want?
Great. Well, that's a great question, and I strongly believe that we are coming up to that zenith, I think that's the top, where consumers may say no more. It does look like the consumer isn't getting raises quite like they have been in the past 18 months to 2 years. And we have seen some restraint in pricing. Like if I look at PepsiCo, they did not raise their prices tremendously, and volumes went down and a little bit. And that gives me a thought that businesses are, especially that kind of consumer, where it cuts on just about every socioeconomic group they're serving. So they're very careful about raising prices now, unlike in the past couple of years. So I think you have to look at your portfolio and figure out who still has who can still raise their prices. And, you know, the big question is inflation really still going up? Do we need to raise prices? And that's what earnings season, my favorite time of year, helps us answer, because we do get answers to that when the analysts ask the important questions.
Yeah, as to whether there is an ability. I mean, it was a whole focus of 2022 and 2023 at the end of COVID, which was about supply chain, wages, and hiking prices to cover some of those costs, or at least that's what they sold us. Rob, in that piece that I just played from Jamie Dimon, of course, he moots the idea that maybe we've got to deal with stagflation. He talks about deficits. He's got everything for a bond investor to worry about: stagflation and deficits. Now, to that extent, I don't know whether stagflation is something that you would even lean into, but the deficit narrative is growing. The auctions are grand for the moment. But from your perspective, how much time do you spend worrying about the deficit? Because politically, it's a no-go area, isn't it?
Yeah, there certainly seems to be no interest in dealing with it from a political perspective. But the deficit is clearly an issue in the medium term. In the short term, we're running deficits that are not that we certainly seem to be able to finance. I think the real concern comes if we get a big slowdown and the deficit expands in a sort of cyclical way, you know, whether that becomes too much to handle, and especially if inflation doesn't come down like we expected. But, you know, as Jamie Dimon, I think one of the things that I think is counter a little bit to what Jamie is saying is, you know, if you look at the consumer for the last several years, they took a big hit in the pandemic, so-called, you know, real disposable income, because inflation ran ahead of their wage increases. If we're right and inflation is coming down more, we should be in a period here. We are in a period where wage increases will be running higher than inflation. So at least for the near term, that's a support for the consumer. Essentially what economists would call, you know, real disposable income should be increasing.
And you're reasonably bullish, Rob, both on high yield and on investment grade. I mean, that would be the base thesis for you. Cuts are coming, disinflation remains intact for you, and therefore you see further compression in spreads rather than just clipping coupon?
Well, I think it's more about the all-in yield, Menace, because of course, I think as many viewers know, spreads are very, very tight.
Yeah.
You know, investment grade spreads are something like 85 basis points over treasuries. The tight since the global financial crisis is something like 77, so we're very close to the tights. So from a spread perspective, it's not that attractive. But in terms of all-in yields, you can get, you know, something like 560 right now in a portfolio of, you know, high-quality investment-grade bonds. And so for an investor with a multi-year horizon, that's where we think the opportunity is. And the problem is if you're not invested, you can't collect that. So we're not overly bullish, but we acknowledge that the value, that the all-in yields look somewhat attractive, and we would be taking exposures there, having it in your portfolio.
Keep on clipping. That's the message. That's the message. Rob, thank you very much. Rob Waldner. Kim Forrest, my guest this morning on the markets. Joining me next to look ahead of the opening bell, it's Abigail Doolittle, as ever. Abby, what have we got?
Well, we have some big outperformance for the NASDAQ 100 futures this morning, not surprisingly having to do with Tesla. Shares are soaring on not so much the quarter, because the quarter wasn't so great, but having everything to do with the color that you all were talking about out of CEO Elon Musk. Convincing investors that the cheaper Tesla will be here by early 2025, if not by year end, and help to drive growth where growth is no longer there for earnings and revenue. As for some other winners on the day, even though the S&P 500 is basically flat, we do have Boeing up 3.7%, a much narrower loss. Revenues beat by 2%. The cash burn was expected. Some analysts saying the defense business has really turned around. AT&T up nearly 3%. They beat profit estimates on a big jump in wireless subscribers. And then finally, Meta, well, the earnings clock and parade and calendar, it continues. This company, big tech company, up 2.5% ahead of reporting earnings tonight. We'll be finding out whether or not, Manus, the results justify the 133% rally over the last year.
Ring the bell for that. Abby, thank you very much. Abigail Doolittle. Coming up, more about Tesla. That stock rallies, but pumps the brake on autonomous driving.
Autonomous driving is one of the hardest challenges to solve for in AI. It's probably just going to take longer than most people expect, and certainly longer than Elon expects.
We're going to take a look at the Tesla story next on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And, you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Autonomous driving is one of the hardest challenges to solve for in AI, and Apple said that, categorically. And so we just think, it will happen, but it's probably just going to take longer than most people expect, and certainly longer than Elon expects. And as a result, we're probably not going to see that impact of the earnings of Tesla till much later in the decade, which for us is a bit longer to be putting into an investment horizon for the stock today.
A detractor in terms of the future of autonomous driving there. But the shares in Tesla, they surged pre-market. The CEO, Elon Musk, slowly restoring investor confidence by unveiling plans to accelerate the launch of cheaper vehicles. Talk was enough. It turns out to be worth 11%. Craig Trudell is with me. Craig, you told me to take a look at Liam Denning's, before we start this conversation, to take a look at Liam Denning's piece, and it encapsulates everything. Musk sells a dream. Don't ask for details. Pay no attention to the EV sales slump. Pay no attention to the hit on margins, and instead, come with me. Imagine robo-taxis.
The numbers are bad, but the words are dreamy, I think was Liam's line, which is pretty great. I also would encourage viewers to go back and read our big take from just a couple days ago, because we told Bloomberg subscribers that this was going to happen, that what Musk was going to do was take some of the work that has been done on the next generation vehicle platform that Tesla's been talking about for some time and apply that to the existing lineup. I think Musk stopped short of referring specifically to essentially, updating the Model Y with some of the work that they've done. And I think for an obvious reason, he doesn't want to have a sort of Osborne effect of, the public hearing that and saying, well, why would I buy a Model Y now when I can get one cheaper, later this year or early next year? I think that therein lies a real question with, whether or not maybe the stock is kind of getting out of hand here. That being said, the shares have been absolutely pummeled. So maybe not a huge shock for there to be a little bit of a rebound after the beating it's taking.
Well, I mean, I'm just looking at what Wedbush have put out. They still have their outperform rating on the stock while lowering their price target to from 300 to 275. But he did promise about the lower costing car, the $25,000 car. And I was drawn to his promise of how cheap that was going to be to produce along with the robo-taxi. He's proffering a much cheaper cost of production without very much detail.
Yeah, and I think, we heard a lot of talk about that just over a year ago at an Investor Day presentation, and it's really, kind of hard to believe that, that Investor Day, event was sort of co-emceed by someone who, by the way, just left within the last week plus when the company started their huge layoffs. And so, we're seeing still some signs of, not all is well at Tesla. And, to Liam's point, the numbers, we shouldn't lose sight of the fact that the fundamentals really fell apart this past quarter. More than $2.5 billion in negative free cash flow. We've never seen that out of Tesla.
What did he have to say about his competitors?
It was interesting. He dished a little dirt. For the last few weeks, there's been so much questions about his strategy. He was critical of other automakers. He didn't name any in particular, but I have a feeling General Motors and Ford were on the tip of his tongue when he said, that the industry is pivoting back from electric vehicles to hybrids. GM and Ford both have announced, changes just within the last few months to their product plans, in light of the fact that the consumer hasn't really come along with, the fully electric vehicles that they've brought to market. Elon said, that is not the right strategy.
Well, one of them is going to have the proof in the pudding, isn't it? Because it's about the infrastructure for the EV relative to the acceptance that it takes time to change decades of traditional consumer behavior. Craig, thank you very much. Craig Trudell. Coming up on the show, your morning calls, and a little bit later we'll catch up with the senior advisor to the president, Gene Sperling, is in New York for a conversation. That on Bloomberg.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Let me just show you the unsung heroes, the bond market. Remember them in the midst of Tesla and the whole technology frenzy that we're in at the moment. The bond market is your anchor. We turned up yesterday, we paid up and looked large in the twos. It was well received. Today you're going to have 7-year paper, you're going to have $70 billion worth of 5-year paper, coming to the market. So it was well bid yesterday. We're cheapening up a little bit into this auction. Some of the other morning calls to be aware of as we go to the opening bell. This is what we got. First up, Citigroup downgrades Molson Coors to a sell, expecting tougher comps following a record year of sales. Mizuho upgrades Airbnb to a buy, seeing the upside from their potential launch of sponsored listings. And finally, Bank of America upgrades Tesla to a buy. This is after their earnings, saying the management effectively addressed the growth concerns. Do you believe that? Did you have enough detail on what will come from the cheaper version of Tesla? Not everybody's convinced. Gabelli's Tony Bancroft joins me around the opening bell to talk Boeing right here on Bloomberg.
looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
on good authority, we've got basketball down at the NYSE. But what we've got going on in the equity market at the moment is a little bit of a bid. You've got this turnaround relief rally coming through on Tesla. Let's see, do the rest of the Magnificent Seven deliver? Because there was a velocity yesterday, which was fairly strong. But in the end of the day, it's about the breadth in the market is down by 0.2%. We're in that show and tell mode when it comes to technology. Yields also on the move slightly ahead of the next auction, which is going to be the 5-year paper coming to the market. You're keeping an eye on 10-year yields, cheapening up by 3 basis points. As I say, the bond bulls lapped up the short-dated paper yesterday in the $70 billion worth of fives coming to the market. You want to lean in this higher for longer narrative. The PMI is a little bit of a slowdown in the US, but we have a cheapening in yields at the moment. Dollar yen, keep an eye on dollar yen because you had more verbiage. You've had the former Vice Minister of Finance talking about being very close to intervention. The Finance Minister, we won't rule out options. So we're keeping a laser-like focus on dollar yen. And crude down by 0.5%. The Middle East fear premium is quite frankly fizzling, maybe a little bit too fast. There is one stock to watch. We've talked about it throughout the show. Tesla, rebounding from a 15-month low. Elon Musk slowly begins to restore investor confidence, vying to accelerate the launch of the cheaper models. And herein lies the point. You've got to believe in two things, Ed, haven't you? You've got to believe in the cheaper model, the cost of production of that, the delivery of that, and autonomous driving. And if you don't believe in my autonomous driving, get off my register.
Pretty succinct message from Elon Musk, and investors are buying that message. The stock's opened up more than 13%. That puts it on track for its biggest jump since January of 2022, or put another way, biggest jump in more than 2 years. You know, that is a stock reaction worth paying attention to. In the quarter gone, let's be under no illusions, it was horrible. Top and bottom line misses, margin erosion, $2.5 billion of cash burn, which is basically the most ever. Inventories at record high 28 days. And they threw the kitchen sink at explaining that away. The transport and logistics issues of the Red Sea, the interruption at their Berlin plant from the arson. They did not say the words interest rates, but did say the words hybrid cars. And I think you talked to Craig about that earlier in the program. The street didn't give a damn about what happened in the first quarter. They lapped up the idea that not only is there an emphasis on affordability and a cheaper model, it is not one single cheaper model. It's a next generation platform which targets cost savings and reductions across a range of Tesla vehicles, the existing 3 and Y lineup and future iterations of it. And frankly, what Tesla spelled out in its shareholder deck was exactly what Dana Hull and I reported on Sunday night, almost verbatim. but we cited sources in that instance. And then there's the autonomy message. I wrote a column on the side last night that it's very clear. If you don't buy the autonomous driving future, don't invest in Tesla, is what Musk said. Now the question is, those bulls, particularly on the institutional Wall Street side, who had a cheap EV at the center of their thesis, do they now buy into the robo-taxi thesis as well?
Yes, and then it is about the global desire to accept those robo-taxis and how quickly that will be done. And thank you very much. Great reporting, great columns. Pick them up on Bloomberg through the day. Let's stick with the earnings stories, because Texas Instruments is enjoying its best day in 4 years. Now, this chip maker topped the first quarter estimates, delivering stronger than expected on the forecast. Abigail Doolittle is with me. So Texas, it's holding them.
Indeed, Texas is holding them, and that's important because over the last few weeks, we've had the SOX, that chip index, down more than 15%. So this is a real bellwether company, an old-school chip company that, as you mentioned, having its best day in 4 weeks, or its best day in 4 years, excuse me, on a big top and bottom line beat for the quarter that was. I think what folks are most impressed by, Manus, is raising the forecast. They're now looking at revenue as much as $3.95 billion. The street is at $3.78 billion. And the thought around this is that companies that buy these chips, finally working through the inventory that has weighed to some degree more recently on the chip index. But into today, Manus, this stock had actually been down about 4%. So this is a big relief for investors for sure. On the day, Texas Instruments right now up 6.2% on that strong quarter and a forecast that beat and raised.
Okay, Abby, thank you very much. AT&T also joining the parade of earnings this morning. Another one that topped estimates, seeing a notable increase in its wireless subscribers. Alex Semenova has the details. Are we tapped into AT&T? Alex, good morning.
Good morning, Manus. It's that subscriber number that everyone is excited about, but beats across most metrics for AT&T. The wireless phone carrier topped both profits and new customers compared to Wall Street estimates. Adjusted earnings per share came in at 55 cents. That was slightly above the 53 cents that Wall Street analysts had called for. The revenue did fall slightly short, $30 billion, just below $30.5 billion everyone had expected. The number that everyone is, of course, psyched about here is the wireless phone subscribers, a really important metric for AT&T. They added 349,000 new customers in the first quarter, well above the roughly 303,000 most people had expected. You could see shares up about 3% here, the best move since January 25th. Under CEO John Stankey, AT&T had shed some of its media businesses and focused on its longtime core business of providing communication services. Still, though, it's been a tough year for AT&T. The stock was down about 1.7% year to date through yesterday's close. It underperformed some of its peers. Verizon was up about 5% over the same period, and T-Mobile up 1.8% this year, Manus.
Alex, thank you very much. Alex Semenova. Well, shares in Boeing are getting a much-needed boost from the earnings, the quarterly results. What did they tell us? They topped estimates across the board. The CEO addressed some of the safety concerns, but it's nothing that the company is, quote, leaving any stone unturned. Katie Greifeld is with us. This comes down to you just didn't burn through as much cash as we thought you were going to.
Yeah, I think better than feared is the phrase to use here. Like you said, Manus, Boeing did burn through about $3.9 billion in the first quarter, but that was better than the $4.4 billion that analysts had been expecting. Meanwhile, they did manage revenue of about $16.57 billion in the first 3 months of the year. That also beat expectations of about $16.25 billion. So as a result, you're seeing a relief rally in the shares right now after really a catastrophic start to the year for Boeing. That dates back, of course, to that January 5th incident. And as a result, Boeing, of course, has been forced to slow its output to really get a grip on its manufacturing and its management. It's still not providing guidance or forecasts, but all of that is good for about a 4% rally in one of this year's worst performers, Manus.
Katie, thank you very much. Yeah, it's about believing in the turnaround. Well, for a little bit more on Boeing, we're joined now by Tony Bancroft of Gabelli Funds Portfolio Management. Tony, thank you for joining us. If the only thing that I'm bidding a stock up on is the fact that its cash burn wasn't as bad as we thought it was going to be, still being run by the management that got us here, it's not a great foundation, is it?
Yeah, it's great to be here, and I think the big picture still is that Boeing is on track with carrying out the FAA plan to improve safety and quality. I think that will will make investors feel much happier, and I think that's the reason why the stock is up this morning. Also, quality escapes are down on the fuselage. They're down 80% versus last month. And, the inventory, the Boeing put out a letter to its employees talking about the inventory going to be mostly burned down by the end of this year from the 787 and the 737. And then the shadow factories will eventually be shut down, which is, will improve productivity a lot. And I think lastly, and probably also as just as importantly as the FAA plan, is that they still believe they can hit the $10 billion free cash flow target by 2026. So I think all those things overall are positives for the stock and for the company itself. It's one of the largest holdings in our Gabelli Commercial Aerospace and Defense ETF GCAD. We're long-term holders and believers that all the tailwinds, the secular tailwinds of commercial aerospace are going to benefit Boeing. They've got essentially unconstrained demand, 10-year plus backlog, and we think it's a great.
Tony, they've got an awful lot to get right in the meantime. They're in a 90-day hiatus on the 737 with the FAA. What is the most optimistic outcome at the end of 90 days with the FAA?
I think the most optimistic is the FAA and Boeing agreed that the 38 per month production limit gets taken off, and they're able to increase production after that. Who knows where that's going to go, but I think again, investors are going to, investors look at Boeing on production rates, and that's going to be the best outcome and the biggest lever for the stock.
How much does getting Spirit on board change the narrative for confidence that Boeing can turn the quality corner and control?
Yeah, I think near term it's like taking medicine. It's going to be probably a painful experience taking Spirit on board. Obviously, they had put the agreement out last night with Spirit for as far as financial agreements, and it just shows all the more reason why Boeing really should be owning Spirit. It's a critical component. The fuselage would be like GM not making their own chassis. They should own this business, and I think they'll be able to improve culture and quality assurance and safety in the long term. And I think, go ahead.
Look, Ryanair, we caught up with the CEO of Ryanair, Michael O'Leary. They've got 600 of these Boeing 737s in their fleet. Michael said the best CEOs are the accountants. That's who he wants to see take over at Boeing. Who do you want to see take over at Boeing? Somebody boring and repetitive on the day-to-day delivery, to quote Michael.
Yeah, I think a great CEO would be Pat Shanahan, the CEO of Spirit Aerosystems. Obviously, he's has a background in engineering, former Boeing employee, and then did a stint in the Department of Defense. And I think he probably have a good vision and knows where Boeing needs to go, and it'd just be probably a logical fit.
Okay, Tony, let's see. You are all in and committed to the stock. Good luck with that. That's Tony Bancroft on the Boeing story. Coming up, the 2024 presidential election race. It heats up. We speak to the senior advisor to the president, Gene Sperling. That's next on Bloomberg.
Season 2 of The Circuit. We're walking with the titans of banking.
Hello! You guys love these meetings.
Yes, we do! And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
and getting you closer to tech and business leaders like never before.
You have our money, you've got world leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging on for dear life.
You driving a Hummer is pretty badass. That's why I'm going for like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financial